1. Introduction to Financial Statements. 1.1 What are financial statements? Financial statements are essential documents that provide a comprehensive overview of a company's financial performance and position. They are prepared by businesses at the end of each accounting period, typically on an annual basis, to communicate important financial information to various stakeholders, such as investors, creditors, and regulators. Financial statements serve as a crucial tool for decision-making, allowing stakeholders to assess the financial health and stability of a company. These statements provide a snapshot of the company's financial activities, including its revenues, expenses, assets, liabilities, and equity. By analyzing these statements, stakeholders can gain insights into the company's profitability, liquidity, solvency, and overall financial performance. There are three primary types of financial statements: the balance sheet, the income statement, and the cash flow statement. Each statement serves a specific purpose and provides different perspectives on the company's financial position. The balance sheet, also known as a statement of financial position, provides a snapshot of the company's assets, liabilities, and equity at a specific point in time. It presents a clear picture of what the company owns, assets, what it owes, liabilities, and the residual value for shareholders' equity. The balance sheet helps stakeholders understand the company's financial stability and its ability to meet its financial obligations. The income statement, also referred to as a statement of comprehensive income or profit and loss statement, reports the company's revenues, expenses, gains, and losses over a specific period. It shows the company's ability to generate revenue, control expenses, and ultimately, its profitability. By analyzing the income statement, stakeholders can assess the company's revenue sources, cost structure, and overall financial performance. The cash flow statement provides insights into the company's cash inflows and outflows during a specific period. It categorizes cash flows into three main activities: operating, investing, and financing. The cash flow statement helps stakeholders understand how the company generates and uses its cash, providing valuable information about its liquidity and ability to meet short-term obligations. Financial statements are prepared in accordance with Generally Accepted Accounting Principles, GAAP, or International Financial Reporting Standards, IFRS. These standards ensure consistency, comparability, and transparency in financial reporting, allowing stakeholders to make informed decisions based on reliable and accurate information. The components of financial statements include not only the primary statements mentioned above but also accompanying notes and disclosures. These notes provide additional information about specific accounting policies, significant events, contingencies, and other relevant details that may impact the interpretation of the financial statements. Financial statements are crucial for various stakeholders. Investors. Investors rely on financial statements to assess the company's financial performance and make informed investment decisions. They analyze the statements to evaluate the company's profitability, growth potential, and overall financial health. Creditors. Creditors, such as banks and lenders, use financial statements to evaluate the company's creditworthiness and determine its ability to repay loans. They assess the company's liquidity, solvency, and cash flow to make lending decisions. Regulators. Regulators, such as government agencies and industry regulators, rely on financial statements to monitor compliance with financial reporting standards and regulations. They use the statements to ensure transparency, accuracy, and fairness in financial reporting. Employees. Employees may refer to financial statements to assess the financial stability and performance of their employer. They may also use the statements to evaluate the company's ability to provide job security and potential for growth. Competitors. Competitors may analyze financial statements to gain insights into the financial strategies, strengths, and weaknesses of their rivals. This information can help them make strategic decisions and identify areas for improvement. In conclusion, financial statements are vital tools for understanding a company's financial performance and position. They provide stakeholders with valuable information to make informed decisions regarding investments, lending, and other business-related matters. By analyzing financial statements, stakeholders can assess a company's profitability, liquidity, solvency, and overall financial health. 1.2 Importance of financial statements. Financial statements are essential tools for understanding the financial health and performance of a company. They provide a comprehensive overview of a company's financial position, profitability, and cash flow. Investors, creditors, analysts, and other stakeholders rely on these statements to make informed decisions about their investments, lending, and business relationships. In this section, we will explore the importance of financial statements and how they can be used to assess the financial standing of a company. Decision-making. Financial statements play a crucial role in decision-making for various stakeholders. Investors, both individual and institutional, rely on financial statements to evaluate the potential returns and risks associated with investing in a particular company. By analyzing the financial statements, investors can assess the company's profitability, growth prospects, and overall financial stability. This information helps them make informed decisions about buying, holding, or selling stocks or other securities. Similarly, creditors, such as banks and financial institutions, use financial statements to evaluate the creditworthiness of a company. By examining the financial statements, creditors can assess the company's ability to repay its debts and determine the terms and conditions of lending. This information is crucial for creditors to manage their risk and make informed decisions about extending credit to a company. Performance evaluation. Financial statements provide a comprehensive view of a company's financial performance over a specific period. By analyzing the income statement, investors and analysts can assess the company's revenue, expenses, and profitability. They can identify trends, patterns, and anomalies that may indicate the company's financial health and performance. The balance sheet provides information about a company's assets, liabilities, and equity. By comparing the balance sheet over multiple periods, stakeholders can evaluate the company's financial position and its ability to meet its short-term and long-term obligations. They can also assess the company's liquidity, solvency, and overall financial stability. The cash flow statement provides insights into a company's cash inflows and outflows from operating, investing, and financing activities. By analyzing the cash flow statement, stakeholders can assess the company's ability to generate cash, manage its working capital, and fund its operations and investments. Transparency and accountability. Financial statements promote transparency and accountability in the corporate world. Publicly traded companies are required by law to prepare and disclose their financial statements to the public. These statements are subject to external audits by independent auditors to ensure their accuracy and compliance with accounting standards. By making financial statements available to the public, companies demonstrate their commitment to transparency and provide stakeholders with the necessary information to assess their financial performance. This transparency helps build trust and confidence among investors, creditors, and other stakeholders. Compliance and regulation. Financial statements are essential for regulatory compliance. Companies must adhere to accounting standards and regulations set by regulatory bodies such as the Financial Accounting Standards Board, FASB, or the International Financial Reporting Standards, IFRS. These standards ensure consistency, comparability, and transparency in financial reporting. Regulatory bodies and government agencies also rely on financial statements to monitor and regulate the financial markets. They use these statements to assess the compliance of companies with accounting standards, detect financial fraud or manipulation, and enforce regulations to protect investors and maintain market integrity. Benchmarking and industry analysis. Financial statements are valuable tools for benchmarking and industry analysis. By comparing a company's financial performance with its competitors or industry averages, stakeholders can assess its relative position and identify areas of strength or weakness. This analysis helps companies set realistic goals, make strategic decisions, and improve their financial performance. Investors and analysts also use financial ratios derived from financial statements to compare companies within the same industry. These ratios provide insights into a company's profitability, liquidity, efficiency, and other key financial metrics. By comparing these ratios, stakeholders can identify industry leaders, assess the competitive landscape, and make informed investment decisions. In conclusion, financial statements are of paramount importance for understanding the financial health and performance of a company. They provide stakeholders with valuable information for decision-making, performance evaluation, transparency, compliance, and industry analysis. By analyzing these statements, investors, creditors, and other stakeholders can make informed decisions, assess risks, and evaluate the financial standing of a company. 1.3 Types of financial statements. Financial statements are essential documents that provide a comprehensive overview of a company's financial performance and position. They are prepared by organizations to communicate their financial information to various stakeholders, including investors, creditors, and regulators. There are 4 main types of financial statements: the balance sheet, income statement, cash flow statement, and statement of changes in equity. Balance sheet. The balance sheet, also known as a statement of financial position, provides a snapshot of a company's financial position at a specific point in time. It presents the company's assets, liabilities, and shareholders' equity. Assets represent what the company owns, such as cash, inventory, and property. Liabilities represent what the company owes, such as loans and accounts payable. Shareholders' equity represents the residual interest in the company's assets after deducting liabilities. The balance sheet follows the fundamental accounting equation: assets equals liabilities plus shareholders' equity. It helps stakeholders understand the company's financial health, liquidity, and solvency. By analyzing the balance sheet, investors can assess the company's ability to meet its short-term and long-term obligations. Income statement. The income statement, also known as a statement of comprehensive income or profit and loss statement, provides information about a company's revenues, expenses, gains, and losses over a specific period. It shows how much revenue the company generated and the expenses incurred to generate that revenue. The difference between revenue and expenses is the net income or net loss. The income statement helps stakeholders evaluate the company's profitability and performance. It provides insights into the company's ability to generate profits from its operations. Investors can analyze the income statement to assess the company's revenue growth, cost management, and overall profitability. It is important to note that the income statement does not provide information about cash flows. Cash flow statement. The cash flow statement, also known as a statement of cash flows, provides information about the cash inflows and outflows of a company during a specific period. It categorizes cash flows into 3 main activities: operating activities, investing activities, and financing activities. Operating activities include cash flows from the company's core operations, such as cash received from customers and cash paid to suppliers. Investing activities include cash flows from buying or selling long-term assets, such as property, plant, and equipment. Financing activities include cash flows from raising or repaying capital, such as issuing or repurchasing shares and borrowing or repaying loans. The cash flow statement helps stakeholders understand the company's ability to generate cash and its cash management practices. It provides insights into the company's liquidity, cash flow generation, and ability to meet its financial obligations. Investors can analyze the cash flow statement to assess the company's cash flow stability and sustainability. Statement of changes in equity. The statement of changes in equity, also known as a statement of retained earnings or statement of shareholders' equity, provides information about the changes in a company's shareholders' equity over a specific period. It shows the beginning balance of shareholders' equity, the changes due to net income or net loss, dividends, share issuances or repurchases, and other comprehensive income. The statement of changes in equity helps stakeholders understand the factors that contribute to the changes in shareholders' equity. It provides insights into the company's profitability, dividend policy, and capital structure. Investors can analyze this statement to assess the company's ability to generate returns for shareholders and its dividend distribution practices. Interrelationships between financial statements. It is important to note that these financial statements are interconnected and provide a holistic view of a company's financial performance and position. The income statement provides information about the company's profitability, which affects the retained earnings in the statement of changes in equity. The net income from the income statement is also used in the cash flow statement to calculate the cash flows from operating activities. The balance sheet provides the ending balances of assets, liabilities, and shareholders' equity, which are carried forward to the next accounting period. The cash flow statement provides information about the cash inflows and outflows, which affects the cash and cash equivalents reported on the balance sheet. By analyzing these financial statements together, stakeholders can gain a comprehensive understanding of a company's financial health, performance, and cash flow dynamics. It enables them to make informed decisions regarding investments, lending, and other business transactions. In the following chapters, we will delve deeper into each financial statement, exploring their components, analyzing ratios derived from them, and understanding their implications for decision-making and financial analysis. 1.4 Components of financial statements. Financial statements are essential documents that provide a comprehensive overview of a company's financial performance and position. They are prepared by organizations to communicate their financial information to various stakeholders, including investors, creditors, employees, and regulators. To understand financial statements fully, it is crucial to be familiar with their components. In this section, we will explore the key components of financial statements and their significance in analyzing a company's financial health. Balance sheet. The balance sheet is one of the primary financial statements that provides a snapshot of a company's financial position at a specific point in time. It consists of three main components: assets, liabilities, and equity. Assets. Assets represent the resources owned by a company that have economic value. They can be classified into two categories: current assets and non-current assets. Current assets include cash, accounts receivable, inventory, and short-term investments. Non-current assets, also known as long-term assets, include property, plant, and equipment, intangible assets, and long-term investments. Liabilities. Liabilities represent the company's obligations or debts to external parties. Like assets, liabilities are also categorized into current liabilities and non-current liabilities. Current liabilities include accounts payable, short-term loans, and accrued expenses. Non-current liabilities, also known as long-term liabilities, include long-term loans, bonds payable, and deferred tax liabilities. Equity. Equity represents the residual interest in the assets of a company after deducting liabilities. It is the ownership interest of the shareholders in the company. Equity can be further divided into two components: contributed capital and retained earnings. Contributed capital represents the amount invested by shareholders, while retained earnings represent the accumulated profits or losses of the company over time. Income statement. The income statement, also known as the profit and loss statement, provides information about a company's revenues, expenses, and net income over a specific period. It consists of the following components. Revenue. Revenue represents the total amount of money earned by a company from its primary business activities. It includes sales revenue, service revenue, rental income, and any other income generated by the company. Expenses. Expenses represent the costs incurred by a company in generating revenue and operating its business. They can be categorized into various types, such as cost of goods sold, operating expenses, interest expenses, and income taxes. Gross profit. Gross profit is calculated by subtracting the cost of goods sold from the revenue. It represents the profit generated from the company's core operations before deducting operating expenses. Operating profit. Operating profit, also known as operating income, is calculated by subtracting operating expenses from gross profit. It reflects the profitability of a company's core operations. Net income. Net income, also referred to as net profit or net earnings, is the final figure on the income statement. It represents the company's total profit after deducting all expenses, including taxes and interest. Cash flow statement. The cash flow statement provides information about the cash inflows and outflows of a company during a specific period. It consists of three main components. Operating activities. Operating activities include cash flows from the company's primary business operations, such as cash received from customers and cash paid to suppliers and employees. Investing activities. Investing activities include cash flows related to the purchase or sale of long-term assets, such as property, plant, and equipment, as well as investments in other companies. Financing activities. Financing activities include cash flows related to the company's financing activities, such as issuing or repurchasing shares, borrowing or repaying loans, and paying dividends. Notes to the financial statements. The notes to the financial statements provide additional information and explanations about the numbers presented in the financial statements. They include details about accounting policies, significant accounting estimates, contingent liabilities, and other relevant information that helps users understand the financial statements better. The notes to the financial statements are crucial for interpreting the financial statements accurately and assessing the company's financial position and performance. They provide insights into the assumptions and judgments made by management in preparing the financial statements and disclose any potential risks or uncertainties that may impact the company's future prospects. In conclusion, financial statements consist of several components that collectively provide a comprehensive view of a company's financial performance and position. Understanding these components is essential for analyzing a company's financial health and making informed decisions. By examining the balance sheet, income statement, cash flow statement, and notes to the financial statements, stakeholders can gain valuable insights into a company's operations, profitability, liquidity, and solvency. 2. Understanding the balance sheet. 2.1 Overview of the balance sheet. The balance sheet is one of the three main financial statements used by businesses to provide a snapshot of their financial position at a specific point in time. It is a crucial document that helps stakeholders, such as investors, creditors, and management, understand the financial health and stability of a company. In this section, we will delve into the details of the balance sheet, its purpose, and the key components it comprises. Purpose of the balance sheet. The primary purpose of the balance sheet is to present a summary of a company's assets, liabilities, and equity at a given date. It provides a clear picture of what the company owns, assets, what it owes, liabilities, and the residual value left for the owner's equity. By comparing these three elements, stakeholders can assess the financial strength, liquidity, and solvency of the business. Structure of the balance sheet. The balance sheet follows a simple equation known as the accounting equation, assets equals liabilities plus equity. This equation ensures that the balance sheet remains balanced, as the name suggests. The assets represent the resources owned by the company, while the liabilities and equity represent the sources of funds used to acquire those assets. The balance sheet is typically divided into two main sections, the left-hand side, which lists the company's assets, and the right-hand side, which shows its liabilities and equity. This division helps users of the financial statements understand how the company has financed its assets and the claims against those assets. Components of the balance sheet. Assets. Assets are the economic resources owned or controlled by a company that have the potential to generate future economic benefits. They are classified into two categories, current assets and non-current assets. Current assets are those that are expected to be converted into cash or used up within 1 year or the operating cycle of the business, whichever is longer. Examples of current assets include cash and cash equivalents, accounts receivable, inventory, and prepaid expenses. Non-current assets, also known as long-term assets, are expected to provide economic benefits for more than 1 year. These assets include property, plant, and equipment, intangible assets, long-term investments, and deferred tax assets. Liabilities. Liabilities represent the company's obligations or debts to external parties. Similar to assets, liabilities are also classified into current and non-current categories. Current liabilities are obligations that are expected to be settled within 1 year or the operating cycle of the business, whichever is longer. Examples of current liabilities include accounts payable, short-term loans, accrued expenses, and current portion of long-term debt. Non-current liabilities, also known as long-term liabilities, are obligations that are due beyond 1 year. These include long-term loans, bonds payable, pension obligations, and deferred tax liabilities. Equity. Equity, also referred to as shareholders' equity or net worth, represents the residual interest in the assets of the company after deducting liabilities. It represents the ownership interest of the shareholders in the business. Equity is further divided into two main components, contributed capital and retained earnings. Contributed capital represents the amount of money or assets contributed by shareholders in exchange for ownership shares. It includes common stock, preferred stock, and additional paid-in capital. Retained earnings, on the other hand, represent the accumulated profits or losses of the company that have not been distributed to shareholders as dividends. It reflects the portion of the company's earnings that has been reinvested back into the business. Importance of the balance sheet. The balance sheet is a vital tool for financial analysis and decision-making. It provides valuable information about a company's financial position, liquidity, and solvency. Here are some key reasons why the balance sheet is important. Assessing financial health. The balance sheet helps stakeholders evaluate the financial health and stability of a company. By analyzing the composition and trends of assets, liabilities, and equity, investors and creditors can determine the company's ability to meet its financial obligations and generate future profits. Measuring liquidity. The balance sheet provides insights into a company's liquidity position by showing the composition of its current assets and liabilities. It helps assess the company's ability to meet short-term obligations and manage its working capital effectively. Evaluating solvency. Solvency refers to a company's ability to meet its long-term obligations. The balance sheet helps stakeholders evaluate the company's solvency by examining the proportion of long-term liabilities to equity. A healthy balance between debt and equity indicates a lower risk of insolvency. Comparing performance. By comparing balance sheets from different periods, stakeholders can analyze the company's financial performance over time. This allows for trend analysis and identification of changes in the company's financial position, such as improvements or deteriorations in liquidity, solvency, or asset composition. Supporting investment decisions. Investors use the balance sheet to assess the financial stability and growth potential of a company before making investment decisions. It provides crucial information about the company's assets, liabilities, and equity, which helps investors determine the value and risk associated with their investment. In conclusion, the balance sheet is a fundamental financial statement that provides a snapshot of a company's financial position at a specific point in time. It helps stakeholders understand the composition of assets, liabilities, and equity, and evaluate the financial health and stability of the business. By analyzing the balance sheet, investors, creditors, and management can make informed decisions regarding investments, creditworthiness, and strategic planning. 2.2 Assets on the balance sheet. The balance sheet is one of the three main financial statements used by companies to provide a snapshot of their financial position at a specific point in time. It presents a summary of a company's assets, liabilities, and equity. In this section, we will focus on understanding the assets section of the balance sheet. What are assets? Assets are resources owned by a company that have economic value and are expected to provide future benefits. They represent the company's investments, properties, and rights that can be used to generate revenue. Assets are classified into different categories based on their nature and liquidity. Current assets. Current assets are those that are expected to be converted into cash or used up within 1 year or the operating cycle of the business, whichever is longer. They are listed on the balance sheet in the order of their liquidity, with the most liquid assets appearing first. Cash and cash equivalents. Cash and cash equivalents include physical currency, bank deposits, and highly liquid investments with a maturity period of 3 months or less. These assets are readily available to meet the company's short-term obligations and fund its day-to-day operations. Short-term investments. Short-term investments are securities that a company intends to sell within a year. These may include marketable securities such as stocks, bonds, and treasury bills. Companies often invest excess cash in short-term investments to earn a return while maintaining liquidity. Accounts receivable. Accounts receivable represent amounts owed to the company by its customers for goods sold or services rendered on credit. They are recorded at the invoiced amount and are expected to be collected within a year. Companies need to carefully manage their accounts receivable to ensure timely collection and minimize the risk of bad debts. Inventory. Inventory includes raw materials, work in progress, and finished goods held by a company for sale or production. It represents the cost of goods that are not yet sold and is an essential asset for manufacturing and retail businesses. Proper inventory management is crucial to ensure efficient operations and avoid excess or obsolete inventory. Prepaid expenses. Prepaid expenses are payments made in advance for goods or services that will be received in the future. They are recorded as assets until the benefits are consumed or the expenses are incurred. Common examples of prepaid expenses include prepaid rent, insurance premiums, and annual subscriptions. Non-current assets. Non-current assets, also known as long-term assets, are those that are not expected to be converted into cash or used up within 1 year. They represent the company's long-term investments and resources. Property, plant, and equipment. Property, plant, and equipment (PP&E) include tangible assets used in the production or operation of a business. This category encompasses land, buildings, machinery, vehicles, and other fixed assets. PP&E is recorded at its historical cost and is subject to depreciation or amortization over its useful life. Intangible assets. Intangible assets lack physical substance but have value due to legal or contractual rights, intellectual property, or brand recognition. Examples of intangible assets include patents, trademarks, copyrights, goodwill, and customer relationships. Intangible assets are typically amortized over their useful life. Investments. Investments in other companies or entities that are not intended for sale within a year are classified as non-current assets. These investments may include equity investments in other companies, long-term loans, or bonds held until maturity. The value of these investments is reported at their fair value or cost, depending on the accounting method used. Long-term receivables. Long-term receivables represent amounts owed to the company that are not expected to be collected within 1 year. They may arise from loans to employees, long-term contracts, or other non-current transactions. Long-term receivables are reported at their present value, taking into account the time value of money. Other non-current assets. This category includes any non-current assets that do not fit into the above classifications. It may include deferred tax assets, long-term prepaid expenses, or any other long-term assets specific to the company's operations. Importance of assets on the balance sheet. The assets section of the balance sheet provides valuable insights into a company's financial health and its ability to generate future cash flows. By analyzing the composition and trends in the asset categories, investors and stakeholders can assess the company's liquidity, solvency, and operational efficiency. Understanding the assets on the balance sheet is crucial for evaluating a company's ability to meet its short-term obligations, invest in growth opportunities, and generate profits. It also helps in comparing the asset structure of different companies within the same industry and identifying potential risks and opportunities. In conclusion, the assets section of the balance sheet provides a comprehensive view of a company's resources and investments. It allows investors, creditors, and other stakeholders to assess the company's financial position and make informed decisions. By understanding the different categories of assets and their significance, readers can gain valuable insights into a company's operations and financial performance. 2.3 Liabilities on the balance sheet. Liabilities are an essential component of the balance sheet, providing valuable insights into a company's financial obligations and its ability to meet them. In this section, we will delve into the various types of liabilities that are typically reported on the balance sheet and explore their significance in evaluating a company's financial health. Understanding liabilities. Liabilities represent the debts and obligations that a company owes to external parties. These obligations arise from past transactions or events and require future settlement, usually involving the transfer of economic resources. Liabilities can be classified into 2 main categories: current liabilities and long-term liabilities. Current liabilities. Current liabilities are obligations that are expected to be settled within 1 year or the operating cycle of the business, whichever is longer. They are typically short-term in nature and include items such as accounts payable, accrued expenses, short-term loans, and current portions of long-term debt. Accounts payable are amounts owed to suppliers for goods or services received but not yet paid for. Accrued expenses represent expenses that have been incurred but not yet paid, such as salaries, utilities, or taxes. Short-term loans are borrowings that are due within 1 year, while the current portion of long-term debt refers to the portion of long-term debt that is due within the next year. Current liabilities are crucial indicators of a company's short-term financial obligations and its ability to meet them. They provide insights into the company's liquidity and working capital management. High levels of current liabilities relative to current assets may indicate potential liquidity issues, while low levels may suggest a strong ability to meet short-term obligations. Long-term liabilities. Long-term liabilities, also known as non-current liabilities, are obligations that are not expected to be settled within the next year or operating cycle. They typically have maturities exceeding 1 year and include items such as long-term debt, deferred tax liabilities, pension obligations, and lease liabilities. Long-term debt represents borrowings that are due beyond the next year. It includes bonds, mortgages, and other long-term loans. Deferred tax liabilities arise from temporary differences between accounting and tax rules, resulting in future tax obligations. Pension obligations represent the company's commitments to provide retirement benefits to its employees. Lease liabilities arise from long-term lease agreements, such as operating leases or finance leases. Long-term liabilities provide insights into a company's long-term financial stability and its ability to manage its debt obligations. They are crucial in assessing a company's solvency and its ability to generate sufficient cash flows to meet long-term obligations. High levels of long-term debt relative to equity may indicate higher financial risk, while low levels may suggest a more conservative capital structure. Significance of liabilities. Liabilities play a vital role in evaluating a company's financial health and assessing its risk profile. They provide valuable information about a company's financial obligations, its ability to meet those obligations, and the potential impact on its overall financial performance. Here are some key reasons why understanding liabilities is crucial. 1. Debt repayment capacity. By analyzing a company's liabilities, investors and creditors can assess its ability to repay its debts. The balance between short-term and long-term liabilities, along with the company's cash flow generation, helps determine its debt repayment capacity. A company with excessive short-term liabilities and limited cash flow may face challenges in meeting its obligations, while a company with a healthy mix of long-term liabilities and strong cash flow may have a better ability to repay its debts. 2. Risk assessment. Liabilities provide insights into a company's risk profile. High levels of debt, both short-term and long-term, can increase a company's financial risk and make it more vulnerable to economic downturns or changes in interest rates. By analyzing the composition and magnitude of liabilities, investors and creditors can assess the level of risk associated with a company and make informed decisions about their investments or lending. 3. Capital structure analysis. The proportion of liabilities to equity on a company's balance sheet reflects its capital structure. A high level of debt relative to equity indicates a more leveraged capital structure, which may increase financial risk but also potentially enhance returns for shareholders. On the other hand, a low level of debt relative to equity suggests a more conservative capital structure with lower financial risk but potentially lower returns. Understanding a company's capital structure helps investors and creditors evaluate its risk-return trade-off and make informed decisions. 4. Liquidity assessment. Current liabilities provide insights into a company's short-term liquidity position. By comparing current liabilities to current assets, investors and creditors can assess a company's ability to meet its short-term obligations. A company with a high ratio of current liabilities to current assets may face liquidity challenges, while a company with a low ratio may have a stronger ability to meet its short-term obligations. 5. Financial health evaluation. Liabilities, along with other financial statement components, help evaluate a company's overall financial health. By analyzing the composition, magnitude, and trends of liabilities, investors and creditors can assess a company's financial stability, solvency, and ability to generate sustainable profits. This evaluation is crucial for making investment decisions, extending credit, or engaging in business transactions with the company. In conclusion, liabilities are a critical component of the balance sheet and provide valuable insights into a company's financial obligations and its ability to meet them. By understanding the types and significance of liabilities, investors, creditors, and other stakeholders can assess a company's financial health, risk profile, and overall stability. Analyzing liabilities in conjunction with other financial statement components helps in making informed decisions and evaluating the potential risks and rewards associated with a company. 2.4 Equity on the balance sheet. Equity is a crucial component of the balance sheet, providing valuable insights into a company's financial health and ownership structure. In this section, we will delve into the concept of equity, its significance, and how it is presented on the balance sheet. Understanding equity. Equity, also known as shareholders' equity or net worth, represents the residual interest in the assets of a company after deducting liabilities. It is the ownership interest of the shareholders in the company's assets and reflects the company's net value. Equity is a critical indicator of a company's financial strength and stability. Equity can be categorized into two main components: contributed capital and retained earnings. Contributed capital refers to the funds invested by shareholders in exchange for ownership shares, such as common stock or preferred stock. Retained earnings, on the other hand, represent the accumulated profits or losses that the company has retained over time. Components of equity. Contributed capital. Contributed capital includes the funds received by the company from shareholders in exchange for ownership shares. It comprises the par value or stated value of the shares issued, additional paid-in capital, and any other capital contributions made by shareholders. The par value is the nominal value assigned to each share, while the additional paid-in capital represents the amount received above the par value. Retained earnings. Retained earnings are the accumulated profits or losses that the company has retained over time. It is the portion of the company's net income that is not distributed to shareholders as dividends but reinvested back into the business. Retained earnings reflect the company's historical profitability and provide an indication of its ability to generate and retain profits. Treasury stock. Treasury stock represents the company's own shares that it has repurchased from shareholders. It is recorded as a reduction in equity and is typically held for various purposes, such as employee stock compensation plans or future reissuance. Treasury stock does not have voting rights and does not receive dividends. Other comprehensive income. Other comprehensive income includes gains and losses that are not recognized in the income statement but are reported directly in equity. These items may include foreign currency translation adjustments, unrealized gains or losses on available for sale securities, and changes in the fair value of certain financial instruments. Presentation on the balance sheet. Equity is presented on the balance sheet as a separate section, usually below liabilities and above the total liabilities and equity line. The equity section is further divided into various components to provide a detailed breakdown of the company's ownership structure and financial position. The balance sheet typically presents equity in the following format. Shareholders' equity. Contributed capital, common stock, preferred stock, additional paid-in capital, retained earnings, treasury stock, other comprehensive income, total shareholders' equity. The contributed capital section includes the different types of shares issued by the company, such as common stock and preferred stock, along with the additional paid-in capital. The retained earnings section reflects the accumulated profits or losses that have been retained by the company. The treasury stock and other comprehensive income sections provide additional information on the company's equity transactions and comprehensive income items. The total shareholders' equity represents the sum of all the equity components and reflects the net worth of the company. It is an essential metric for investors, creditors, and other stakeholders to assess the financial health and value of the company. Analyzing equity. Analyzing the equity section of the balance sheet can provide valuable insights into a company's financial position and performance. Here are a few key points to consider when analyzing equity. Capital structure. The composition of equity, including the proportion of contributed capital and retained earnings, can provide insights into the company's capital structure and financing decisions. A higher proportion of contributed capital may indicate a more conservative financing approach, while a significant amount of retained earnings may suggest a history of profitability and reinvestment. Dividend policy. The retained earnings section reflects the company's dividend policy and its willingness to distribute profits to shareholders. A consistent increase in retained earnings may indicate a company's commitment to reinvesting in growth opportunities, while a significant decrease in retained earnings may suggest a higher dividend payout ratio. Share repurchases. The treasury stock section reveals whether the company has repurchased its own shares. Share repurchases can be a sign of confidence in the company's future prospects or a strategy to enhance shareholder value. However, excessive share repurchases may also indicate a lack of investment opportunities or financial distress. Comprehensive income. The other comprehensive income section provides insights into the impact of non-operating items on the company's equity. Analyzing these items can help assess the company's exposure to foreign currency fluctuations, changes in the fair value of investments, and other comprehensive income-related risks. By thoroughly analyzing the equity section of the balance sheet, investors and analysts can gain a deeper understanding of a company's financial position, capital structure, and shareholder value. It serves as a vital tool for decision-making, risk assessment, and evaluating the long-term sustainability of a company's operations. 3. Analyzing the income statement. 3.1 Overview of the income statement. The income statement, also known as the profit and loss statement or statement of earnings, is one of the three main financial statements used by businesses to communicate their financial performance to stakeholders. It provides a summary of a company's revenues, expenses, and net income over a specific period of time, typically a year or a quarter. The primary purpose of the income statement is to show how much profit or loss a company has generated during the reporting period. It helps investors, creditors, and other stakeholders assess the profitability and financial health of a business. By analyzing the income statement, stakeholders can gain insights into a company's revenue sources, cost structure, and overall financial performance. Structure of the income statement. The income statement is structured in a way that allows for a clear presentation of a company's revenues, expenses, and net income. It typically consists of the following sections. Revenue. This section represents the total amount of money generated from the sale of goods or services. It includes sales revenue, service revenue, rental income, and any other sources of income directly related to the core operations of the business. Cost of goods sold (COGS). This section includes the direct costs associated with producing or delivering the goods or services sold by the company. It includes the cost of raw materials, direct labor, and manufacturing overhead. Subtracting the COGS from the revenue gives the gross profit. Operating expenses. This section includes all the expenses incurred in the day-to-day operations of the business. It includes items such as salaries and wages, rent, utilities, marketing expenses, research and development costs, and other general and administrative expenses. Non-operating income and expenses. This section includes any income or expenses that are not directly related to the core operations of the business. It may include items such as interest income, interest expense, gains or losses from the sale of assets, and other non-operating items. Income taxes. This section represents the income tax expense incurred by the company during the reporting period. It is calculated based on the company's taxable income and the applicable tax rate. Net income. This is the final section of the income statement and represents the company's bottom line. It is calculated by subtracting the total expenses, including taxes, from the total revenue. Net income is a measure of the company's profitability and is often used to assess its financial performance. Key metrics and ratios. The income statement provides several key metrics and ratios that can be used to evaluate a company's financial performance and profitability. Some of the commonly used metrics include gross profit margin. This ratio measures the percentage of revenue that remains after deducting the cost of goods sold. It indicates how efficiently a company is managing its production costs and pricing its products. Operating profit margin. This ratio measures the percentage of revenue that remains after deducting both the cost of goods sold and operating expenses. It reflects the company's ability to generate profit from its core operations. Net profit margin. This ratio measures the percentage of revenue that remains as net income after deducting all expenses, including taxes. It provides an overall view of the company's profitability. Earnings per share (EPS). This metric represents the portion of a company's net income allocated to each outstanding share of common stock. It is often used by investors to assess the company's profitability on a per-share basis. Return on assets (ROA). This ratio measures the company's ability to generate profit from its total assets. It indicates how efficiently the company is utilizing its assets to generate income. Return on equity (ROE). This ratio measures the company's ability to generate profit from the shareholders' equity. It indicates the return on investment for the shareholders. Limitations of the income statement. While the income statement provides valuable insights into a company's financial performance, it has certain limitations that should be considered when analyzing the statement. Some of these limitations include non-cash items. The income statement includes non-cash items such as depreciation and amortization expenses, which do not directly impact the company's cash flow. Therefore, it is important to consider the cash flow statement in conjunction with the income statement for a comprehensive analysis. Timing of revenue and expenses. The income statement records revenues and expenses based on the accrual accounting method, which may not always reflect the actual cash inflows and outflows. This can lead to discrepancies between reported profits and actual cash flows. Subjectivity in expense recognition. The income statement requires management to make judgments and estimates when recognizing certain expenses, such as bad debt provisions or warranty expenses. These estimates can vary between companies and may impact the accuracy of the reported financial results. Lack of non-financial information. The income statement focuses solely on financial performance and does not provide information about non-financial factors such as customer satisfaction, employee morale, or market share. Therefore, it should be used in conjunction with other sources of information for a comprehensive assessment of a company's overall performance. In conclusion, the income statement is a crucial financial statement that provides insights into a company's revenue, expenses, and profitability. By analyzing the income statement, stakeholders can assess a company's financial performance, evaluate its profitability, and make informed decisions about investing or lending to the business. However, it is important to consider the limitations of the income statement and use it in conjunction with other financial statements and non-financial information for a comprehensive analysis. 3.2 Revenue and Expenses. Revenue and expenses are two crucial components of the income statement, which provides a snapshot of a company's financial performance over a specific period. Understanding revenue and expenses is essential for investors, analysts, and stakeholders to evaluate a company's profitability and sustainability. Revenue. Revenue, also known as sales or turnover, represents the total amount of money generated by a company from its primary business activities. It is the top line of the income statement and is a key indicator of a company's ability to generate income. Revenue can come from various sources, such as the sale of goods, provision of services, or licensing agreements. Types of revenue. There are different types of revenue that a company may report in its financial statements. Sales revenue. This is the most common type of revenue and represents the income generated from the sale of goods or services. It includes both cash and credit sales. Service revenue. Service-based companies, such as consulting firms or software as a service providers, generate revenue primarily from providing services to clients. Service revenue is recognized when the services are performed or delivered. Interest revenue. Companies that have investments or provide loans may earn interest income. Interest revenue is typically derived from interest-bearing assets, such as bonds, loans, or bank deposits. Royalty revenue. Companies that own intellectual property, such as patents or copyrights, may earn royalty income from licensing their rights to other entities. Royalty revenue is usually based on a percentage of the licensee's sales or usage. Rental revenue. Companies that own or lease out properties or equipment can generate rental income. This revenue is recognized when the lessee uses the property or equipment. Revenue recognition. Revenue recognition is the process of recording revenue in the financial statements. It is governed by accounting principles, such as Generally Accepted Accounting Principles, GAAP, or International Financial Reporting Standards, IFRS. The timing of revenue recognition depends on the nature of the revenue and the terms of the underlying transaction. In general, revenue is recognized when it is earned and realizable. This means that the company has substantially completed its obligations, and the collection of payment is reasonably assured. The specific criteria for revenue recognition may vary across industries and can be complex, especially for long-term contracts or multiple deliverable arrangements. Expenses. Expenses are the costs incurred by a company in its day-to-day operations to generate revenue. They represent the resources consumed or obligations arising from the company's activities. Expenses are deducted from revenue to calculate the net income or profit of a company. Types of expenses. Companies may have various types of expenses, depending on their industry and business model. Some common types of expenses include cost of goods sold (COGS). COGS represents the direct costs associated with producing or acquiring the goods sold by a company. It includes the cost of raw materials, direct labor, and manufacturing overhead. For service-based companies, this category is often referred to as a cost of services. Operating expenses. Operating expenses are the costs incurred in the day-to-day operations of a business. They include expenses such as rent, utilities, salaries, marketing, research and development, and administrative costs. Operating expenses are essential for a company to maintain its operations and generate revenue. Interest expense. Interest expense is the cost of borrowing funds from lenders, such as banks or bondholders. It includes interest payments on loans, bonds, or other forms of debt. Interest expense is tax deductible for most companies. Depreciation and amortization. Depreciation and amortization expenses represent the systematic allocation of the cost of long-term assets over their useful lives. Depreciation is associated with tangible assets, such as buildings or equipment, while amortization applies to intangible assets, such as patents or copyrights. Income taxes. Income taxes are the taxes levied on a company's taxable income. The amount of income tax expense depends on the applicable tax laws and regulations in the company's jurisdiction. Expense recognition. Similar to revenue recognition, expense recognition follows accounting principles and guidelines. Expenses are recognized in the period in which they contribute to the generation of revenue, regardless of when the actual payment occurs. This principle is known as the matching principle, which aims to match expenses with the revenue they help generate. However, some expenses, such as prepaid expenses or long-term assets, may be recognized over multiple periods through the process of amortization or depreciation. This allows for a more accurate representation of the expenses incurred in generating revenue over time. Understanding revenue and expenses is crucial for analyzing a company's financial performance. By examining the trends and patterns in revenue and expenses, investors and analysts can gain insights into a company's profitability, cost structure, and overall financial health. It is important to consider revenue and expense ratios, such as gross profit margin, operating profit margin, and net profit margin, to assess a company's efficiency and profitability compared to its industry peers. 3.3 Gross profit and operating profit. In the previous section, we discussed revenue and expenses, which are the key components of the income statement. Now, let's delve deeper into two important measures of profitability: gross profit and operating profit. Gross profit. Gross profit is a fundamental metric that provides insights into a company's ability to generate revenue and manage its cost of goods sold (COGS). It represents the profit a company makes after deducting the direct costs associated with producing or delivering its products or services. To calculate gross profit, we subtract the COGS from the total revenue. COGS includes expenses directly related to the production or acquisition of goods, such as raw materials, labor, and manufacturing overhead. Gross profit is a crucial indicator of a company's operational efficiency and pricing strategy. Investors and analysts use gross profit to assess a company's ability to control production costs and maintain a competitive advantage. A higher gross profit margin indicates that a company is effectively managing its production costs and generating more profit from each unit sold. Comparing the gross profit margin of a company with its industry peers can provide valuable insights into its competitive position. A higher gross profit margin relative to competitors suggests that the company has a cost advantage or can command higher prices for its products or services. Operating profit. Operating profit, also known as operating income or operating earnings, is another key measure of a company's profitability. It represents the profit generated from the core operations of the business, excluding non-operating expenses and income. To calculate operating profit, we subtract operating expenses from the gross profit. Operating expenses include costs incurred in running the day-to-day operations of the business, such as salaries, rent, utilities, marketing expenses, and research and development costs. Operating profit is a critical metric for evaluating a company's operational efficiency and profitability. It provides insights into how well a company is managing its operating expenses and generating profit from its core business activities. A higher operating profit margin indicates that a company is effectively controlling its operating expenses and generating more profit from its revenue. It demonstrates the company's ability to generate sustainable profits from its core operations. Investors and analysts often compare the operating profit margin of a company with its industry peers to assess its operational efficiency and profitability. A higher operating profit margin relative to competitors suggests that the company is more efficient in managing its operating expenses and generating profit. Relationship between gross profit and operating profit. Gross profit and operating profit are closely related but represent different aspects of a company's profitability. Gross profit focuses on the direct costs associated with producing or delivering goods or services, while operating profit considers both direct and indirect costs related to the core operations of the business. The difference between gross profit and operating profit lies in the inclusion of non-operating expenses and income. Non-operating expenses and income include items such as interest expenses, gains or losses from the sale of assets, and income from investments. By analyzing both gross profit and operating profit, investors and analysts can gain a comprehensive understanding of a company's profitability. Gross profit provides insights into the efficiency of the production process, while operating profit considers the overall profitability of the business, including operating expenses. It is important to note that a company can have a high gross profit margin but a low operating profit margin if it incurs significant operating expenses. Conversely, a company with a low gross profit margin can still have a high operating profit margin if it effectively manages its operating expenses. Limitations of gross profit and operating profit. While gross profit and operating profit are valuable measures of profitability, they have certain limitations that investors and analysts should consider. Firstly, both metrics do not account for non-operating expenses and income, which can significantly impact a company's overall profitability. It is essential to analyze the complete income statement, including non-operating items, to gain a comprehensive understanding of a company's financial performance. Secondly, gross profit and operating profit do not consider the impact of taxes and interest expenses. These expenses are accounted for in the net income, which provides a more accurate measure of a company's profitability after considering all costs and expenses. Lastly, gross profit and operating profit should be analyzed in conjunction with other financial ratios and metrics to gain a holistic view of a company's financial health and performance. It is important to consider factors such as liquidity, solvency, and return on investment when evaluating a company's profitability. In conclusion, gross profit and operating profit are essential measures of a company's profitability. Gross profit focuses on the direct costs associated with producing goods or services, while operating profit considers both direct and indirect costs related to the core operations of the business. By analyzing these metrics, investors and analysts can assess a company's operational efficiency and profitability. However, it is crucial to consider the limitations of these metrics and analyze them in conjunction with other financial ratios and metrics for a comprehensive evaluation of a company's financial performance. 3.4 Net income and earnings per share. Net income and earnings per share are important financial metrics that provide insights into a company's profitability and performance. In this section, we will delve into the details of net income and earnings per share, how they are calculated, and their significance in evaluating a company's financial health. Net income. Net income, also known as net profit or net earnings, is a key measure of a company's profitability. It represents the amount of money a company has earned after deducting all expenses, taxes, and interest from its total revenue. Net income is reported on the income statement, which is one of the three main financial statements. To calculate net income, we start with the company's total revenue and subtract all the expenses incurred during a specific period. These expenses include the cost of goods sold, operating expenses, interest expenses, and taxes. The formula for calculating net income is as follows. Net income equals total revenue, total expenses. Net income is a crucial indicator of a company's financial performance because it shows how effectively the company is generating profits from its operations. A higher net income indicates that the company is generating more revenue than its expenses, while a lower net income suggests that the company's expenses are outweighing its revenue. Investors and analysts closely monitor a company's net income to assess its profitability and growth potential. A consistent increase in net income over time is generally considered a positive sign, indicating that the company is growing and becoming more profitable. On the other hand, a decline in net income may raise concerns about the company's financial health and its ability to generate sustainable profits. Earnings per share (EPS). Earnings per share (EPS) is a financial ratio that measures the portion of a company's net income allocated to each outstanding share of common stock. EPS is a widely used metric to assess a company's profitability on a per-share basis and is often considered a key factor in determining a company's stock price. EPS is calculated by dividing the company's net income by the weighted average number of outstanding shares during a specific period. The formula for calculating EPS is as follows. EPS equals net income, weighted average number of shares. The weighted average number of shares takes into account any changes in the number of outstanding shares during the period, such as stock splits, stock dividends, or share repurchases. By using the weighted average, EPS provides a more accurate representation of the company's earnings per share. EPS is an important metric for investors as it helps them evaluate the profitability of a company's stock and compare it with other companies in the same industry. A higher EPS indicates that the company is generating more earnings for each share of stock, which is generally viewed as positive by investors. Conversely, a lower EPS may raise concerns about the company's profitability and its ability to generate returns for shareholders. It is worth noting that EPS can be calculated on a trailing 12-month (TTM) basis or on a quarterly basis, depending on the reporting period. TTM EPS provides a broader view of a company's earnings over the past year, while quarterly EPS reflects the company's performance in a specific quarter. Investors often use EPS as a basis for valuing a company's stock. The price-to-earnings (PE) ratio, which compares the stock price to the company's EPS, is a commonly used valuation metric. A higher PE ratio suggests that investors are willing to pay a premium for the company's earnings, indicating positive market sentiment. Conversely, a lower PE ratio may indicate that the stock is undervalued or that investors have concerns about the company's future earnings potential. In conclusion, net income and earnings per share are essential financial metrics that provide valuable insights into a company's profitability and performance. Net income measures the company's overall profitability, while EPS assesses its profitability on a per-share basis. Investors and analysts closely monitor these metrics to evaluate a company's financial health, growth potential, and stock valuation. Understanding and analyzing net income and EPS can help investors make informed decisions and assess the financial performance of a company. 4. Interpreting the cash flow statement. 4.1 Purpose and importance of the cash flow statement. The cash flow statement is a crucial financial statement that provides valuable insights into the cash inflows and outflows of a company over a specific period. It presents a comprehensive summary of the cash generated from operating activities, investing activities, and financing activities. By analyzing the cash flow statement, investors, analysts, and other stakeholders can gain a deeper understanding of a company's liquidity, solvency, and overall financial health. Understanding the purpose of the cash flow statement. The primary purpose of the cash flow statement is to provide information about the cash generated and used by a company during a specific period. It helps users assess the company's ability to generate cash, meet its financial obligations, and fund its operations. Unlike the income statement and balance sheet, which focus on accrual accounting, the cash flow statement provides a clear picture of the actual cash movements within the company. The cash flow statement serves several important purposes. Assessing liquidity. The cash flow statement helps evaluate a company's liquidity by analyzing its ability to generate cash from its core operations. It provides insights into the company's ability to pay its short-term obligations and fund its day-to-day activities. Identifying cash flow trends. By comparing cash flow statements from different periods, stakeholders can identify trends in a company's cash flow. This analysis helps in understanding whether the company's cash flow is improving or deteriorating over time. Evaluating operational efficiency. The cash flow statement allows users to assess the efficiency of a company's operations by analyzing its cash flow from operating activities. Positive cash flow from operations indicates that the company is generating sufficient cash from its core business activities. Analyzing investment decisions. The cash flow statement provides insights into a company's investing activities, including capital expenditures, acquisitions, and divestitures. This information helps investors evaluate the company's investment decisions and assess its long-term growth prospects. Assessing financing activities. The cash flow statement reveals how a company raises capital and manages its debt. It provides information about cash inflows from financing activities such as issuing stocks or bonds and cash outflows from debt repayments or dividend payments. This analysis helps stakeholders understand the company's financial structure and its ability to meet its financial obligations. Importance of the cash flow statement. The cash flow statement holds significant importance for various stakeholders, including investors, creditors, analysts, and management. Here are some key reasons why the cash flow statement is crucial. Investment decision-making. Investors rely on the cash flow statement to assess a company's ability to generate cash and its overall financial health. By analyzing the cash flow statement, investors can make informed decisions about buying, holding, or selling a company's stock. Creditworthiness evaluation. Creditors, such as banks and financial institutions, use the cash flow statement to evaluate a company's ability to repay its debts. By assessing the company's cash flow from operating activities, creditors can determine whether the company has sufficient cash flow to meet its debt obligations. Financial performance analysis. The cash flow statement complements the income statement and balance sheet in analyzing a company's financial performance. It provides a more accurate representation of a company's cash position and its ability to generate cash from its core operations. Forecasting and planning. The cash flow statement helps in forecasting future cash flows and planning for future financial needs. By analyzing historical cash flow patterns, companies can make informed decisions about capital investments, dividend payments, and debt management. Detecting financial manipulation. The cash flow statement can help identify potential financial manipulation or creative accounting practices. By comparing the cash flow statement with the income statement and balance sheet, stakeholders can identify inconsistencies and assess the quality of reported earnings. Communication with stakeholders. The cash flow statement provides transparent and reliable information about a company's cash flows. It enhances communication between the company and its stakeholders, enabling them to make informed decisions based on accurate financial information. In conclusion, the cash flow statement plays a vital role in understanding a company's cash inflows and outflows. It provides valuable insights into a company's liquidity, solvency, and overall financial health. By analyzing the cash flow statement, stakeholders can make informed investment decisions, evaluate a company's creditworthiness, assess its financial performance, and plan for the future. Understanding the purpose and importance of the cash flow statement is essential for anyone involved in analyzing financial statements and making informed financial decisions. 4.2 Operating activities. Operating activities are a crucial aspect of a company's financial statements. They provide valuable insights into the day-to-day operations of a business and help investors and stakeholders understand how the company generates its revenue and manages its expenses. In this section, we will delve into the details of operating activities and explore their significance in financial statement analysis. Understanding operating activities. Operating activities refer to the core business activities that generate revenue for a company. These activities involve the production, sale, and delivery of goods or services, as well as any other activities directly related to the company's primary operations. Operating activities are reflected in the income statement and the cash flow statement. The income statement captures the revenue generated from the sale of goods or services and deducts the associated expenses to calculate the operating profit or loss. It provides a snapshot of the company's financial performance over a specific period, typically a year. The cash flow statement, on the other hand, focuses on the cash inflows and outflows resulting from operating activities. Components of operating activities. Operating activities encompass various components that contribute to a company's financial performance. Some of the key components include revenue generation. Revenue generation is the primary objective of operating activities. It represents the income generated from the sale of goods or services. Revenue can be derived from various sources, such as product sales, service fees, licensing agreements, or rental income. Analyzing revenue trends and patterns can provide insights into the company's market position, customer demand, and overall business growth. Cost of goods sold, COGS. The cost of goods sold, COGS, represents the direct costs associated with producing or acquiring the goods sold by a company. It includes expenses such as raw materials, labor costs, and manufacturing overheads. COGS is subtracted from revenue to calculate the gross profit, which indicates the profitability of the company's core operations. Operating expenses. Operating expenses encompass all the costs incurred in running the day-to-day operations of a business. These expenses include salaries and wages, rent, utilities, marketing expenses, research and development costs, and administrative expenses. Analyzing the trends and composition of operating expenses can provide insights into the efficiency and effectiveness of a company's operations. Depreciation and amortization. Depreciation and amortization are non-cash expenses that reflect the gradual wear and tear or the expiration of intangible assets over time. Depreciation applies to tangible assets such as buildings, machinery, and equipment, while amortization applies to intangible assets like patents, copyrights, and trademarks. These expenses are deducted from revenue to calculate the operating profit. Changes in working capital. Working capital represents the difference between a company's current assets and current liabilities. Changes in working capital can have a significant impact on a company's operating activities. An increase in working capital, such as higher accounts receivable or inventory levels, may indicate a strain on cash flow, while a decrease may suggest improved liquidity. Analyzing working capital changes helps assess a company's ability to manage its short-term obligations. Importance of analyzing operating activities. Analyzing operating activities is crucial for understanding a company's financial health and performance. It provides insights into the efficiency, profitability, and sustainability of a company's core operations. Here are some key reasons why analyzing operating activities is important. Performance evaluation. Analyzing operating activities allows investors and stakeholders to evaluate a company's financial performance. By examining revenue trends, gross profit margins, and operating expenses, one can assess the company's ability to generate consistent revenue, control costs, and achieve profitability. This analysis helps identify areas of strength and weakness within the company's operations. Cash flow assessment. Operating activities have a direct impact on a company's cash flow. Analyzing the cash flow statement helps assess the company's ability to generate cash from its core operations. Positive cash flow from operating activities indicates that the company's operations are generating sufficient cash to cover expenses and invest in growth opportunities. Conversely, negative cash flow may suggest cash flow challenges or inefficiencies in the company's operations. Forecasting and planning. Analyzing operating activities provides valuable insights for forecasting and planning purposes. By understanding revenue drivers, cost structures, and working capital dynamics, companies can make informed decisions about resource allocation, pricing strategies, and operational improvements. This analysis helps in setting realistic financial goals and developing effective strategies to achieve them. Comparisons and benchmarks. Analyzing operating activities allows for meaningful comparisons and benchmarks within an industry or against competitors. By comparing revenue growth rates, gross profit margins, and operating expenses, investors can assess a company's relative performance and identify industry trends. Benchmarking against industry leaders can provide insights into best practices and areas for improvement. In conclusion, operating activities play a vital role in a company's financial statements. They provide valuable insights into a company's revenue generation, cost management, and overall financial performance. Analyzing operating activities helps investors and stakeholders evaluate a company's financial health, assess its cash flow position, and make informed decisions about investment and resource allocation. 4.3 Investing activities. Investing activities are an essential part of a company's financial statements. They provide valuable insights into how a company is allocating its resources to generate future growth and enhance shareholder value. In this section, we will explore the significance of investing activities and how they are reported in the cash flow statement. Understanding investing activities. Investing activities primarily involve the acquisition, disposal, and management of long-term assets and investments. These activities are crucial for a company's long-term sustainability and expansion. By investing in assets and projects, companies aim to generate future cash flows and increase their overall value. Investing activities can include various transactions, such as purchase or sale of property, plant, and equipment (PP&E). Companies may invest in acquiring or disposing of physical assets like land, buildings, machinery, and vehicles. These investments are essential for the company's operations and can impact its future profitability. Acquisition or sale of investments. Companies may invest in acquiring or selling financial assets like stocks, bonds, or other securities. These investments can provide additional income through dividends, interest, or capital gains. Loans and advances to other entities. Companies may provide loans or advances to other entities, such as subsidiaries, associates, or related parties. These investments can generate interest income and strengthen business relationships. Purchase or sale of intangible assets. Companies may invest in acquiring or disposing of intangible assets like patents, trademarks, copyrights, or licenses. These assets can provide competitive advantages and contribute to the company's long-term success. Investment in joint ventures or partnerships. Companies may enter into joint ventures or partnerships with other entities to pursue specific projects or business opportunities. These investments can provide access to new markets, technologies, or resources. Cash flows from insurance settlements or disposals. Companies may receive cash inflows from insurance settlements or disposals of assets due to theft, damage, or obsolescence. These cash flows can help offset losses or fund new investments. Reporting investing activities in the cash flow statement. The cash flow statement is a financial statement that provides information about a company's cash inflows and outflows during a specific period. It is divided into three main sections: operating activities, investing activities, and financing activities. In the investing activities section of the cash flow statement, companies report the cash flows related to their investing activities. These cash flows can be either positive inflows or negative outflows and are categorized as follows. Cash inflows from investing activities. These include cash received from the sale of long-term assets, investments, or other financial instruments. It also includes cash received from the repayment of loans or advances made to other entities. Cash outflows from investing activities. These include cash paid for the purchase of long-term assets, investments, or other financial instruments. It also includes cash paid for the acquisition of subsidiaries, associates, or joint ventures. The net cash flow from investing activities is calculated by subtracting the total cash outflows from the total cash inflows. This net cash flow provides insights into whether a company is investing more in its future growth or divesting assets to generate cash. Interpreting investing activities. Analyzing the investing activities of a company can provide valuable insights into its growth strategy, capital allocation decisions, and overall financial health. Here are some key points to consider when interpreting investing activities. Capital expenditure. The purchase of property, plant, and equipment (PP&E) is a significant investing activity. Higher capital expenditure may indicate that a company is investing in expanding its operations or upgrading its infrastructure. Conversely, a decrease in capital expenditure may suggest a more conservative approach or a focus on optimizing existing assets. Acquisitions and divestitures. The acquisition or sale of subsidiaries, joint ventures, or other businesses can significantly impact a company's financial position. It is essential to assess the rationale behind these transactions and evaluate their potential impact on future cash flows and profitability. Investment in research and development (R&D). Companies that invest heavily in R&D demonstrate a commitment to innovation and future growth. Analyzing the cash flows related to R&D investments can provide insights into a company's focus on developing new products, technologies, or intellectual property. Cash flow sustainability. It is crucial to assess whether a company's investing activities generate sustainable cash flows. For example, if a company consistently relies on selling assets or investments to fund its operations, it may indicate underlying financial challenges or a lack of profitability. Long-term value creation. Evaluating the quality and potential return on investment of a company's investing activities is essential. Companies that strategically invest in projects or assets with high growth potential and strong competitive advantages are more likely to create long-term value for their shareholders. In conclusion, investing activities play a vital role in a company's financial statements and provide insights into its growth strategy and capital allocation decisions. Analyzing the cash flows related to investing activities can help investors and stakeholders assess a company's future prospects, financial health, and ability to generate sustainable value. 4.4 Financing activities. Financing activities are an essential part of a company's financial statements. They provide valuable insights into how a company raises capital and manages its financial obligations. In this section, we will explore the significance of financing activities and understand how they are presented in the cash flow statement. Understanding financing activities. Financing activities refer to the activities undertaken by a company to raise capital and manage its financial structure. These activities involve obtaining funds from various sources and repaying the company's obligations. Financing activities are crucial for a company's growth, as they provide the necessary capital to invest in operations, expand the business, or meet financial obligations. Sources of financing. Companies can raise capital through various sources, including equity financing. Equity financing involves raising funds by issuing shares of stock to investors. This can be done through initial public offerings, IPOs, or private placements. Equity financing allows companies to raise capital without incurring debt obligations. However, it dilutes the ownership stake of existing shareholders. Debt financing. Debt financing involves borrowing money from lenders or issuing debt securities such as bonds or debentures. Companies can obtain debt financing from banks, financial institutions, or through the issuance of corporate bonds. Debt financing provides companies with the necessary funds while allowing them to retain ownership control. However, it comes with the obligation to repay the borrowed amount along with interest. Lease financing. Lease financing involves obtaining assets through lease agreements rather than purchasing them outright. This allows companies to use assets without the need for significant upfront capital. Lease financing is commonly used for equipment, vehicles, or real estate. It provides flexibility and reduces the financial burden on the company. Government grants and subsidies. Some companies may receive financial assistance from the government in the form of grants or subsidies. These funds are typically provided to support specific projects or industries. Government grants and subsidies can significantly impact a company's financing activities and should be disclosed in the financial statements. Presentation in the cash flow statement. Financing activities are presented in the cash flow statement, which provides a summary of a company's cash inflows and outflows during a specific period. The cash flow statement is divided into 3 sections: operating activities, investing activities, and financing activities. The financing activities section of the cash flow statement includes the following. Proceeds from issuance of equity. This includes the cash received from issuing new shares of stock. It represents the inflow of capital from equity financing activities. Proceeds from borrowings. This includes the cash received from borrowing funds through loans, bonds, or other debt instruments. It represents the inflow of capital from debt financing activities. Repayment of borrowings. This includes the cash outflows from repaying borrowed funds. It represents the repayment of principal amounts and interest payments. Payment of dividends. This includes the cash outflows from distributing dividends to shareholders. Dividends are typically paid out of the company's profits and represent a return on investment for shareholders. Purchase of treasury stock. This includes the cash outflows from repurchasing the company's own shares. Companies may repurchase shares to reduce the number of outstanding shares or to support the stock price. Payment of lease obligations. This includes the cash outflows from fulfilling lease obligations. It represents the repayment of lease payments for leased assets. Other financing activities. This includes any other cash flows related to financing activities that are not covered by the above categories. It may include items such as the issuance of convertible debt, changes in short-term borrowings, or the repayment of long-term debt. Importance of analyzing financing activities. Analyzing financing activities is crucial for investors, creditors, and other stakeholders to assess a company's financial health and stability. By understanding how a company raises capital and manages its financial obligations, stakeholders can make informed decisions regarding their investments or creditworthiness. Key considerations when analyzing financing activities include debt levels. Examining the amount of debt a company has incurred and its ability to repay it is essential. High levels of debt can indicate financial risk and potential difficulties in meeting financial obligations. Equity dilution. Monitoring the issuance of new shares can help assess the impact on existing shareholders' ownership stake. Significant equity dilution may affect the company's control and future earnings per share. Dividend policy. Analyzing the payment of dividends can provide insights into a company's profitability and its commitment to returning value to shareholders. Consistent dividend payments may indicate a stable and profitable business. Lease obligations. Understanding the company's lease obligations is crucial, especially for industries that heavily rely on leased assets. High lease obligations may impact cash flow and financial flexibility. Changes in financing structure. Analyzing changes in the company's financing structure over time can provide insights into its financial strategy and risk management. For example, a shift from debt financing to equity financing may indicate a desire to reduce financial risk. By carefully analyzing financing activities, stakeholders can gain a comprehensive understanding of a company's financial position, its ability to raise capital, and its financial stability. This information is vital for making informed investment decisions, assessing creditworthiness, and evaluating the overall financial health of a company. 5. Understanding financial ratios. 5.1 Introduction to Financial Ratios. Financial ratios are powerful tools that help investors, analysts, and other stakeholders assess the financial health and performance of a company. By analyzing the relationships between different financial statement items, ratios provide valuable insights into a company's profitability, liquidity, solvency, and efficiency. This section will introduce you to the concept of financial ratios and explain their significance in evaluating a company's financial position. What are financial ratios? Financial ratios are mathematical calculations that express the relationship between different financial statement items. They are used to measure various aspects of a company's financial performance and provide a standardized way to compare companies within the same industry or across different industries. Ratios can be classified into different categories based on the financial statement items they involve, such as liquidity ratios, profitability ratios, and solvency ratios. Why are financial ratios important? Financial ratios play a crucial role in financial analysis for several reasons. Performance evaluation. Ratios help assess a company's performance over time by comparing its financial results to previous periods or industry benchmarks. They provide a snapshot of how well a company is utilizing its resources and generating profits. Comparison. Ratios enable investors and analysts to compare companies within the same industry or across different industries. This comparison helps identify companies that outperform their peers or industry averages, as well as those that may be underperforming. Trend analysis. By analyzing ratios over multiple periods, trends can be identified. This helps identify patterns and changes in a company's financial performance, which can be useful in making investment decisions or evaluating management effectiveness. Risk assessment. Ratios provide insights into a company's financial risk and stability. They help assess a company's ability to meet its short-term and long-term obligations, as well as its overall financial health. Investment decision-making. Financial ratios are essential tools for investors when making investment decisions. They provide valuable information about a company's profitability, growth potential, and financial stability, helping investors determine whether to buy, hold, or sell a company's stock. Types of financial ratios. Financial ratios can be categorized into several types, each focusing on a specific aspect of a company's financial performance. The main categories of financial ratios include liquidity ratios. Liquidity ratios measure a company's ability to meet its short-term obligations. They assess the company's ability to convert its assets into cash to cover its current liabilities. Examples of liquidity ratios include the current ratio, quick ratio, and cash ratio. Profitability ratios. Profitability ratios measure a company's ability to generate profits relative to its sales, assets, or equity. They provide insights into a company's efficiency in generating profits and its overall profitability. Examples of profitability ratios include gross profit margin, operating profit margin, and return on equity. Solvency ratios. Solvency ratios assess a company's long-term financial stability and its ability to meet its long-term obligations. These ratios focus on the company's capital structure and its ability to generate sufficient cash flow to cover its debt obligations. Examples of solvency ratios include debt-to-equity ratio, interest coverage ratio, and debt ratio. Efficiency ratios. Efficiency ratios measure how effectively a company utilizes its assets and resources to generate sales and profits. These ratios provide insights into a company's operational efficiency and its ability to manage its assets. Examples of efficiency ratios include inventory turnover ratio, accounts receivable turnover ratio, and asset turnover ratio. Market ratios. Market ratios assess a company's valuation in the stock market and its attractiveness to investors. These ratios compare a company's stock price to its earnings, book value, or sales. Examples of market ratios include price-to-earnings ratio, price-to-book ratio, and price-to-sales ratio. Understanding and analyzing these different types of financial ratios will provide you with a comprehensive view of a company's financial performance and position. By examining ratios from each category, you can gain insights into various aspects of a company's operations, profitability, and financial health. In the next section, we will delve deeper into liquidity ratios, which provide insights into a company's short-term financial health and its ability to meet its immediate obligations. 5.2 Liquidity ratios. Liquidity ratios are financial ratios that measure a company's ability to meet its short-term obligations and its overall liquidity position. These ratios provide valuable insights into a company's ability to generate cash and pay off its current liabilities. By analyzing liquidity ratios, investors and creditors can assess the financial health and stability of a company. Current ratio. The current ratio is one of the most commonly used liquidity ratios. It measures a company's ability to pay off its short-term liabilities using its current assets. The formula for calculating the current ratio is current ratio equals current assets, current liabilities. A higher current ratio indicates a better liquidity position, as it suggests that the company has more current assets to cover its current liabilities. Generally, a current ratio of 1 or higher is considered favorable, as it indicates that the company has sufficient assets to cover its short-term obligations. However, it is important to note that a very high current ratio may also indicate that the company is not efficiently utilizing its assets. For example, if a company has a large amount of cash sitting idle in its current assets, it may not be generating a high return on investment. Therefore, it is crucial to consider other factors and ratios in conjunction with the current ratio to get a comprehensive understanding of a company's liquidity position. Quick ratio. The quick ratio, also known as the acid test ratio, is a more stringent measure of liquidity compared to the current ratio. It excludes inventory from current assets, as inventory may not be easily converted into cash in the short term. The formula for calculating the quick ratio is quick ratio equals current assets, inventory, current liabilities. The quick ratio provides a more conservative assessment of a company's ability to meet its short-term obligations. It focuses on the most liquid assets, such as cash, marketable securities, and accounts receivable, which can be quickly converted into cash. A higher quick ratio indicates a stronger liquidity position, as it suggests that the company can meet its short-term liabilities without relying on the sale of inventory. Similar to the current ratio, a quick ratio of 1 or higher is generally considered favorable. However, it is important to compare the quick ratio with the industry average and the company's historical data to gain meaningful insights. Industries with high inventory turnover, such as retail, may have lower quick ratios compared to industries with lower inventory turnover, such as technology. Cash ratio. The cash ratio is the most conservative liquidity ratio, as it measures a company's ability to pay off its current liabilities using only its cash and cash equivalents. It excludes other current assets, such as accounts receivable and inventory, which may not be readily available for immediate payment. The formula for calculating the cash ratio is cash ratio equals cash plus cash equivalents, current liabilities. The cash ratio provides a clear picture of a company's immediate liquidity position. A higher cash ratio indicates a stronger ability to meet short-term obligations without relying on the conversion of other assets into cash. However, it is important to note that a very high cash ratio may also indicate that the company is not effectively utilizing its resources to generate revenue. Operating cash flow ratio. The operating cash flow ratio measures a company's ability to generate cash from its core operations to cover its current liabilities. It focuses on the cash flow from operating activities, which includes cash inflows and outflows directly related to the company's primary business operations. The formula for calculating the operating cash flow ratio is operating cash flow ratio equals operating cash flow, current liabilities. A higher operating cash flow ratio indicates a stronger ability to generate cash from operations to meet short-term obligations. It demonstrates that the company's core business is generating sufficient cash flow to cover its current liabilities. This ratio is particularly important for companies with negative net income or high levels of non-cash expenses, as it provides insights into their cash generation capabilities. Interpretation and limitations. Liquidity ratios are crucial for assessing a company's short-term financial health and its ability to meet its obligations. However, it is important to interpret these ratios in the context of the industry, company size, and business model. Different industries have varying liquidity requirements, and what may be considered a favorable liquidity ratio in one industry may not be the same in another. Moreover, liquidity ratios only provide a snapshot of a company's liquidity position at a specific point in time. They do not consider the timing of cash flows or the quality of assets. For a more comprehensive analysis, it is essential to consider other financial ratios, such as profitability ratios and solvency ratios, along with qualitative factors. In conclusion, liquidity ratios play a vital role in assessing a company's ability to meet its short-term obligations. By analyzing these ratios, investors and creditors can gain insights into a company's liquidity position and make informed decisions regarding investment or lending. However, it is crucial to consider these ratios in conjunction with other financial metrics and qualitative factors to obtain a holistic understanding of a company's financial health. 5.3 Profitability ratios. Profitability ratios are financial metrics that measure a company's ability to generate profits and earnings from its operations. These ratios provide valuable insights into a company's profitability and help investors, analysts, and stakeholders assess its financial performance. By analyzing profitability ratios, one can evaluate a company's ability to generate returns for its shareholders and determine its overall financial health. Profitability ratios are essential tools for investors and analysts as they provide a comprehensive view of a company's profitability and its ability to generate sustainable earnings. These ratios are calculated using various financial statement items, such as revenue, expenses, and net income. Let's explore some of the most commonly used profitability ratios. Gross profit margin. The gross profit margin measures the percentage of revenue that remains after deducting the cost of goods sold (COGS). It indicates how efficiently a company manages its production costs and pricing strategies. A higher gross profit margin suggests that a company has better control over its production costs and can charge higher prices for its products or services. The formula for calculating the gross profit margin is as follows. Gross profit margin equals revenue, COGS, revenue * 100 operating profit margin. The operating profit margin measures the percentage of revenue that remains after deducting both the cost of goods sold, COGS, and operating expenses. It reflects a company's ability to generate profits from its core operations. A higher operating profit margin indicates that a company is effectively managing its operating expenses and generating higher profits. The formula for calculating the operating profit margin is as follows. Operating profit margin equals operating profit, revenue * 100 net profit margin. The net profit margin measures the percentage of revenue that remains after deducting all expenses, including taxes and interest. It represents the overall profitability of a company and its ability to generate profits for its shareholders. A higher net profit margin indicates that a company is efficiently managing its expenses and generating higher profits. The formula for calculating the net profit margin is as follows. Net profit margin equals net income, revenue * 100 return on assets, ROA. Return on assets, ROA, measures the profitability of a company relative to its total assets. It indicates how effectively a company utilizes its assets to generate profits. A higher ROA suggests that a company is efficiently utilizing its assets to generate higher profits. The formula for calculating the return on assets is as follows. Return on assets, ROA, equals net income, total assets * 100 return on equity, ROE. Return on equity, ROE, measures the profitability of a company relative to its shareholders' equity. It indicates how effectively a company generates profits for its shareholders' investment. A higher ROE suggests that a company is generating higher returns for its shareholders. The formula for calculating the return on equity is as follows. Return on equity, ROE, equals net income, shareholders' equity * 100 earnings per share, EPS. Earnings per share, EPS, measures the profitability of a company on a per-share basis. It indicates the portion of a company's earnings allocated to each outstanding share of common stock. EPS is an important metric for investors as it helps them assess the profitability of their investment. The formula for calculating earnings per share is as follows. Earnings per share, EPS, equals net income, number of outstanding shares. Profitability ratios provide valuable insights into a company's financial performance and help investors and analysts make informed investment decisions. However, it is important to note that profitability ratios should not be analyzed in isolation. They should be compared to industry benchmarks, historical performance, and other companies in the same sector to gain a comprehensive understanding of a company's profitability. When analyzing profitability ratios, it is crucial to consider the industry norms and the company's business model. Different industries have varying levels of profitability due to factors such as competition, market conditions, and economic cycles. Therefore, it is essential to compare a company's profitability ratios with its industry peers to assess its relative performance. In conclusion, profitability ratios are vital tools for assessing a company's financial performance and profitability. By analyzing these ratios, investors and analysts can gain insights into a company's ability to generate profits, manage expenses, and generate returns for its shareholders. However, it is important to consider these ratios in conjunction with other financial metrics and industry benchmarks to make well-informed investment decisions. 5.4 Solvency Ratios. Solvency ratios are financial metrics that assess a company's ability to meet its long-term financial obligations. These ratios provide insights into a company's financial health and its ability to repay its debts. Solvency ratios are crucial for investors, creditors, and other stakeholders as they help evaluate the risk associated with a company's financial position. Debt-to-equity ratio. One of the key solvency ratios is the debt-to-equity ratio. This ratio measures the proportion of a company's total debt to its shareholders' equity. It indicates the extent to which a company relies on debt financing compared to equity financing. A higher debt-to-equity ratio suggests that a company has a higher level of debt relative to its equity, which may indicate higher financial risk. To calculate the debt-to-equity ratio, divide the total debt by the shareholders' equity. The formula is as follows. Debt-to-equity ratio equals total debt, shareholders' equity. A debt-to-equity ratio of 1 indicates that a company has an equal amount of debt and equity. Ratios above 1 indicate higher debt levels, while ratios below 1 suggest a higher proportion of equity financing. Debt ratio. The debt ratio is another important solvency ratio that measures the proportion of a company's total assets financed by debt. It provides insights into the company's leverage and its ability to repay its debts. A higher debt ratio indicates a higher level of debt relative to the company's assets, which may increase financial risk. To calculate the debt ratio, divide the total debt by the total assets. The formula is as follows. Debt ratio equals total debt, total assets. A debt ratio of 0.5 indicates that 50% of the company's assets are financed by debt. Ratios above 0.5 suggest a higher reliance on debt financing, while ratios below 0.5 indicate a higher proportion of equity financing. Interest coverage ratio. The interest coverage ratio assesses a company's ability to meet its interest payments on outstanding debt. It measures the company's earnings relative to its interest expenses. A higher interest coverage ratio indicates a company's ability to comfortably meet its interest obligations, while a lower ratio may suggest potential financial difficulties. To calculate the interest coverage ratio, divide the company's earnings before interest and taxes (EBIT) by its interest expenses. The formula is as follows. Interest coverage ratio equals EBIT, interest expenses. A ratio of 2 indicates that the company's earnings are twice the amount of its interest expenses. Ratios below 1 suggest that the company's earnings are insufficient to cover its interest payments. Debt service coverage ratio. The debt service coverage ratio evaluates a company's ability to meet its debt obligations, including both principal and interest payments. It provides insights into the company's cash flow generation and its capacity to repay its debts. A higher debt service coverage ratio indicates a stronger ability to meet debt obligations. To calculate the debt service coverage ratio, divide the company's net operating income by its total debt service. The formula is as follows. Debt service coverage ratio equals net operating income, total debt service. A ratio of 1 indicates that the company's net operating income is equal to its total debt service. Ratios above 1 suggest that the company generates sufficient cash flow to cover its debt obligations. Cash flow to debt ratio. The cash flow to debt ratio measures a company's ability to generate cash flow from its operations to cover its outstanding debt. It assesses a company's ability to generate sufficient cash flow to meet its debt obligations. A higher cash flow to debt ratio indicates a stronger ability to repay debts. To calculate the cash flow to debt ratio, divide the company's operating cash flow by its total debt. The formula is as follows. Cash flow to debt ratio equals operating cash flow, total debt. A ratio of 0.5 indicates that the company's operating cash flow is half the amount of its total debt. Ratios above 0.5 suggest that the company generates sufficient cash flow to cover its debt obligations. Conclusion. Solvency ratios are essential tools for assessing a company's long-term financial stability and its ability to meet its debt obligations. These ratios provide valuable insights into a company's financial health and risk profile. By analyzing solvency ratios, investors, creditors, and other stakeholders can make informed decisions about investing in or lending to a company. It is important to consider solvency ratios in conjunction with other financial ratios and factors to gain a comprehensive understanding of a company's financial position. 6. Analyzing the notes to the financial statements. 6.1 Importance of notes to the financial statements. When analyzing financial statements, it is crucial to not overlook the importance of the notes to the financial statements. These notes, also known as the footnotes, provide additional information and explanations that are essential for a comprehensive understanding of the financial statements. While the balance sheet, income statement, and cash flow statement provide a summary of the company's financial performance, the notes offer valuable insights into the underlying details and assumptions. Enhancing transparency and disclosure. One of the primary purposes of the notes to the financial statements is to enhance transparency and disclosure. These notes provide detailed explanations about the accounting policies, methodologies, and assumptions used in preparing the financial statements. They also disclose any significant judgments or estimates made by management that could impact the financial results. By providing this additional information, the notes help users of financial statements, such as investors, analysts, and regulators, to better understand the financial position and performance of the company. This transparency is crucial for making informed decisions and assessing the reliability of the financial statements. Clarifying accounting policies and methods. The notes to the financial statements play a vital role in clarifying the accounting policies and methods employed by the company. These policies outline how the company recognizes, measures, and presents various items in the financial statements. For example, they may explain the depreciation method used for fixed assets, the inventory valuation method, or the revenue recognition criteria. Understanding the accounting policies is essential because they can significantly impact the reported financial results. Different policies can lead to variations in the valuation of assets, recognition of revenue, or measurement of liabilities. By providing detailed explanations of these policies, the notes help users of financial statements to assess the consistency and comparability of the company's financial performance over time and in comparison to other companies in the industry. Disclosing contingent liabilities and risks. Another critical aspect covered in the notes to the financial statements is the disclosure of contingent liabilities and risks. Contingent liabilities are potential obligations that may arise in the future, depending on the outcome of uncertain events. These could include pending lawsuits, warranty claims, or guarantees provided by the company. By disclosing these contingent liabilities, the notes provide users of financial statements with a more complete picture of the company's financial position and potential risks. This information is crucial for assessing the company's ability to meet its obligations and for evaluating the potential impact on future cash flows. Providing segment information. In some cases, companies operate in multiple business segments or geographical regions. The notes to the financial statements often provide segment information, which breaks down the financial results and position of the company by these different segments. This segmentation allows users of financial statements to analyze the performance and profitability of each segment individually. Segment information is particularly useful for investors and analysts who want to assess the company's diversification, growth prospects, and risk exposure across different business lines or regions. It helps them understand which segments are driving the company's overall performance and identify any areas of concern or potential opportunities. Disclosing related party transactions. Related party transactions refer to transactions between the company and its related parties, such as its subsidiaries, affiliates, key management personnel, or significant shareholders. These transactions may not be conducted at arm's length and could potentially impact the company's financial position and performance. The notes to the financial statements disclose any significant related party transactions, including the nature of the transactions, the parties involved, and the amounts involved. This information is crucial for users of financial statements to assess the potential conflicts of interest and ensure that these transactions are conducted on fair terms. Compliance with accounting standards and regulations. The notes to the financial statements also play a crucial role in demonstrating the company's compliance with accounting standards and regulations. They provide information about any changes in accounting standards, new pronouncements, or amendments that have been adopted by the company. By disclosing these changes, the notes help users of financial statements to understand the impact on the financial results and ensure that the company is following the appropriate accounting principles. This compliance is essential for maintaining the integrity and reliability of the financial statements. In conclusion, the notes to the financial statements are a vital component of the overall financial reporting process. They provide additional information, explanations, and disclosures that enhance transparency, clarify accounting policies, disclose contingent liabilities and risks, provide segment information, disclose related party transactions, and demonstrate compliance with accounting standards and regulations. By carefully reviewing and analyzing the notes, users of financial statements can gain a deeper understanding of the company's financial position, performance, and potential risks. 6.2 Types of notes. In addition to the balance sheet, income statement, and cash flow statement, another important component of financial statements is the notes to the financial statements. These notes provide additional information and explanations that are essential for a comprehensive understanding of the company's financial position and performance. The notes to the financial statements are typically found at the end of the annual report and are an integral part of the financial reporting process. The types of notes included in the financial statements can vary depending on the company and the industry in which it operates. However, there are some common types of notes that are typically found in most annual reports. Let's explore some of these types of notes. 1. Accounting policies. One of the most important types of notes is the accounting policies note. This note provides detailed information about the accounting principles and methods used by the company in preparing its financial statements. It includes information about the company's revenue recognition policy, inventory valuation method, depreciation method, and other significant accounting policies. Understanding the accounting policies is crucial for interpreting the financial statements correctly and comparing the financial performance of different companies. 2. Significant accounting estimates. Companies often make significant accounting estimates that can have a material impact on their financial statements. These estimates include the valuation of assets and liabilities, determination of useful lives for depreciation, and estimation of provisions for doubtful debts or warranty expenses. The notes to the financial statements provide information about these significant accounting estimates, including the assumptions used and the potential impact on the financial statements if the estimates were to change. 3. Contingent liabilities and commitments. Contingent liabilities and commitments are potential obligations that may arise in the future, depending on the outcome of uncertain events. The notes to the financial statements disclose information about these contingent liabilities and commitments, such as pending lawsuits, guarantees, or long-term contracts. This information is important for assessing the company's potential risks and obligations that may affect its financial position. 4. Related party transactions. Related party transactions are transactions between the company and its related parties, such as its subsidiaries, affiliates, or key management personnel. These transactions may not be conducted at arm's length and can have an impact on the company's financial position and performance. The notes to the financial statements provide details about these related party transactions, including the nature of the transactions, the amounts involved, and any outstanding balances. 5. Segment reporting. Segment reporting is required for companies operating in multiple business segments or geographical regions. The notes to the financial statements provide information about the company's operating segments, including their revenue, profit or loss, assets, and liabilities. This information helps investors and analysts understand the performance of each segment and evaluate the company's overall business strategy. 6. Subsequent events. Subsequent events or transactions that occur after the balance sheet date but before the financial statements are issued. These events can have a significant impact on the company's financial position and performance. The notes to the financial statements disclose information about any material subsequent events that occurred after the balance sheet date but before the financial statements were finalized. 7. Fair value measurements. Fair value measurements are used to determine the value of certain assets and liabilities that are not easily measurable based on their historical cost. The notes to the financial statements provide information about the company's fair value measurements, including the valuation techniques used and the significant inputs used in the valuation process. This information is important for understanding the company's financial instruments and the potential impact of changes in fair value on its financial statements. 8. Other disclosures. In addition to the above types of notes, there may be other disclosures included in the notes to the financial statements. These disclosures can vary depending on the company's specific circumstances and industry requirements. Some examples of other disclosures include employee benefit plans, environmental liabilities, research and development activities, and significant non-cash transactions. It is important for investors, analysts, and other stakeholders to carefully review the notes to the financial statements to gain a comprehensive understanding of the company's financial position and performance. These notes provide valuable insights into the company's accounting policies, significant estimates, contingent liabilities, related party transactions, and other important information that may not be apparent from the face of the financial statements alone. By analyzing the notes, stakeholders can make more informed decisions and assessments about the company's financial health and prospects. 6.3 Key information in the notes. The notes to the financial statements are an integral part of a company's annual report. They provide additional information and explanations that complement the data presented in the financial statements. While the financial statements themselves offer a summary of a company's financial performance, position, and cash flows, the notes provide essential details and disclosures that help users understand the numbers better. The key information in the notes can vary depending on the company and its industry. However, there are some common elements that are typically found in the notes to the financial statements. Let's explore some of the key information that can be found in these notes. 1. Summary of significant accounting policies. One of the essential sections in the notes is a summary of significant accounting policies. This section outlines the specific accounting principles and methods used by the company in preparing its financial statements. It provides details on how the company recognizes revenue, values assets and liabilities, and records expenses. Understanding the accounting policies is crucial for users to assess the reliability and comparability of the financial statements. 2. Revenue recognition. The notes often include information about the company's revenue recognition policies. This section explains how the company recognizes revenue from its primary activities, such as the sale of goods or services. It may provide details on the timing of revenue recognition, any specific criteria that need to be met, and any significant estimates involved in determining the amount of revenue to be recognized. 3. Inventory valuation. For companies that carry inventory, the notes may include information about the valuation methods used. This section may explain whether the company uses the cost of goods sold (COGS) method, the first in, first out FIFO method, or the weighted average cost method. It may also disclose any significant write-downs or adjustments made to the inventory value. 4. Depreciation and amortization. The notes often provide details on the company's depreciation and amortization policies. This section may explain the useful lives and methods used to depreciate or amortize the company's assets. It may also disclose any changes in the depreciation or amortization methods and the impact of those changes on the financial statements. 5. Leases and commitments. If the company has significant lease agreements or commitments, the notes may include information about these arrangements. This section may disclose the nature of the leases, the lease terms, and any significant future obligations. It may also provide details on any lease incentives received or granted by the company. 6. Contingent liabilities and commitments. The notes often disclose any contingent liabilities or commitments that the company may have. Contingent liabilities are potential obligations that may arise from past events but are uncertain in terms of timing or amount. This section may provide details on legal disputes, warranties, guarantees, or other potential liabilities that could have a significant impact on the company's financial position. 7. Related party transactions. Companies sometimes engage in transactions with related parties, such as key management personnel, significant shareholders, or other entities under common control. The notes may include information about these related party transactions, including the nature of the transactions, the amounts involved, and any outstanding balances. This disclosure is important to ensure transparency and to assess the potential impact of these transactions on the company's financial statements. 8. Significant events or transactions. The notes may also disclose any significant events or transactions that occurred during the reporting period. This section may include information about mergers, acquisitions, divestitures, or other material transactions that could impact the company's financial position. It may also provide details on any subsequent events that occurred after the reporting period but before the financial statements were issued. 9. Subsequent events. The notes often include information about subsequent events that occurred after the reporting period but before the financial statements were issued. This section may disclose any significant events, transactions, or changes that could impact the company's financial position. It is important for users to be aware of these subsequent events to have a more up-to-date understanding of the company's financial status. 10. Other disclosures. In addition to the above, the notes may include other disclosures specific to the company or industry. These could include information about employee benefit plans, income taxes, research and development activities, environmental liabilities, or any other significant matters that require disclosure to provide a comprehensive understanding of the company's financial statements. It is important for users to carefully review the notes to the financial statements to gain a deeper understanding of the company's financial performance and position. The notes provide valuable context, explanations, and additional details that are not always apparent from the financial statements alone. By analyzing the key information in the notes, users can make more informed decisions and assessments about the company's financial health and prospects. 6.4 Interpreting the notes. The notes to the financial statements are an essential part of understanding a company's financial position and performance. These notes provide additional information and explanations that complement the data presented in the balance sheet, income statement, and cash flow statement. Interpreting the notes requires careful analysis and attention to detail, as they can reveal important insights about a company's operations, risks, and financial decisions. Purpose of the notes. The primary purpose of the notes to the financial statements is to provide users with a deeper understanding of the numbers presented in the main financial statements. They serve as a bridge between the raw financial data and the context in which it should be interpreted. The notes provide explanations, clarifications, and additional details that are not readily apparent from the face of the financial statements alone. Types of notes. There are various types of notes that can be found in the financial statements, each serving a specific purpose. Some common types of notes include accounting policies. These notes outline the specific accounting principles and methods used by the company in preparing its financial statements. They provide transparency and consistency in the application of accounting standards. Significant accounting estimates. These notes disclose the key assumptions and judgments made by management in determining certain financial statement amounts. Examples include the estimation of bad debts, inventory valuation, and useful lives of assets. Contingent liabilities. These notes disclose potential liabilities that may arise in the future, depending on the outcome of uncertain events. Examples include pending lawsuits, warranty claims, or environmental liabilities. Related party transactions. These notes disclose any transactions between the company and its related parties, such as key management personnel, significant shareholders, or subsidiaries. These transactions may require additional scrutiny due to the potential for conflicts of interest. Segment reporting. If a company operates in multiple business segments, these notes provide information about the performance and financial position of each segment. This helps users understand the company's diversification and the risks associated with each segment. Subsequent events. These notes disclose significant events or transactions that occurred after the reporting period but before the financial statements were issued. Examples include mergers, acquisitions, or changes in accounting policies. Key information in the notes. When interpreting the notes to the financial statements, it is important to focus on key information that can provide valuable insights into a company's financial health and performance. Some key areas to pay attention to include revenue recognition. The notes may provide details on the company's revenue recognition policies, including any specific criteria or conditions that must be met before revenue can be recognized. This information helps assess the reliability and sustainability of the company's revenue streams. Significant accounting policies. Understanding the company's accounting policies is crucial for evaluating the quality and comparability of its financial statements. Pay attention to any changes in accounting policies and their potential impact on the reported financial results. Contingent liabilities and risks. The notes may disclose potential risks and uncertainties that could have a material impact on the company's financial position. This includes information on legal disputes, pending regulatory changes, or potential disruptions to the business. Related party transactions. Transactions with related parties can raise concerns about potential conflicts of interest or the manipulation of financial results. Analyzing these notes can help identify any unusual or significant related party transactions. Subsequent events. Pay attention to any significant events or transactions that occurred after the reporting period. These events may have a material impact on the company's financial position and should be considered when evaluating its current financial statements. Analyzing the notes. To effectively interpret the notes to the financial statements, it is important to approach them with a critical mindset and attention to detail. Here are some steps to follow when analyzing the notes. Read the notes in conjunction with the financial statements. The notes should be read alongside the balance sheet, income statement, and cash flow statement to gain a comprehensive understanding of the company's financial position and performance. Identify the key areas of interest. Determine which notes are most relevant to your analysis based on the nature of the company's operations, industry-specific considerations, and any specific areas of concern. Compare notes across different periods. Analyze how the information provided in the notes has changed over time. Look for any significant changes in accounting policies, contingent liabilities, or related party transactions that could impact the company's financial position. Consider the materiality of the information. Assess the materiality of the information disclosed in the notes. Focus on notes that contain information that could have a significant impact on the company's financial statements or the user's decision-making process. Seek professional advice if needed. If you encounter complex accounting policies or unfamiliar terminology in the notes, consider seeking advice from a financial professional or accountant who can provide further clarification. Interpreting the notes to the financial statements requires a thorough understanding of accounting principles, industry-specific considerations, and the company's specific circumstances. By carefully analyzing the information provided in the notes, users can gain valuable insights into a company's financial health, risks, and performance, enabling them to make more informed decisions. 7. Evaluating financial performance. 7.1 Financial Performance Metrics. Financial performance metrics are essential tools for evaluating a company's financial health and performance. These metrics provide valuable insights into various aspects of a company's operations, profitability, efficiency, and overall financial well-being. By analyzing these metrics, investors, analysts, and stakeholders can make informed decisions about the company's financial prospects and potential risks. Key financial performance metrics. There are several key financial performance metrics that analysts commonly use to assess a company's financial performance. These metrics can be categorized into different areas, including profitability, liquidity, solvency, and efficiency. Let's explore some of the most commonly used financial performance metrics. 1. Profitability metrics. Profitability metrics measure a company's ability to generate profits from its operations. These metrics provide insights into the company's ability to generate revenue, control costs, and manage its resources effectively. Some commonly used profitability metrics include gross profit margin. This metric measures the percentage of revenue that remains after deducting the cost of goods sold. A higher gross profit margin indicates better cost control and pricing power. Operating profit margin. This metric measures the percentage of revenue that remains after deducting both the cost of goods sold and operating expenses. It reflects the company's ability to generate profits from its core operations. Net profit margin. This metric measures the percentage of revenue that remains after deducting all expenses, including taxes and interest. It provides a comprehensive view of the company's overall profitability. 2. Liquidity metrics. Liquidity metrics assess a company's ability to meet its short-term obligations and manage its cash flow effectively. These metrics help determine whether a company has enough liquid assets to cover its current liabilities. Some commonly used liquidity metrics include current ratio. This metric compares a company's current assets to its current liabilities. A ratio greater than 1 indicates that the company has sufficient assets to cover its short-term obligations. Quick ratio. This metric is similar to the current ratio but excludes inventory from current assets. It provides a more conservative measure of a company's liquidity. Cash ratio. This metric measures the company's ability to cover its current liabilities with its cash and cash equivalents. A higher cash ratio indicates a stronger liquidity position. 3. Solvency metrics. Solvency metrics evaluate a company's long-term financial stability and its ability to meet its long-term obligations. These metrics assess the company's capital structure and its ability to generate sustainable profits. Some commonly used solvency metrics include debt-to-equity ratio. This metric compares a company's total debt to its shareholders' equity. It indicates the proportion of a company's financing that comes from debt. A higher ratio may indicate higher financial risk. Interest coverage ratio. This metric measures a company's ability to cover its interest expenses with its operating profits. It reflects the company's ability to service its debt obligations. Debt-to-asset ratio. This metric compares a company's total debt to its total assets. It provides insights into the company's overall leverage and financial risk. 4. Efficiency metrics. Efficiency metrics assess a company's ability to utilize its resources effectively and generate maximum output from its operations. These metrics help identify areas where the company can improve its operational efficiency. Some commonly used efficiency metrics include inventory turnover ratio. This metric measures how quickly a company sells its inventory. A higher ratio indicates efficient inventory management and faster inventory turnover. Accounts receivable turnover ratio. This metric measures how quickly a company collects payments from its customers. A higher ratio indicates effective credit management and faster cash flow. Asset turnover ratio. This metric measures how efficiently a company utilizes its assets to generate revenue. A higher ratio indicates better asset utilization and productivity. Interpreting financial performance metrics. While financial performance metrics provide valuable insights, it is crucial to interpret them in the context of the industry, company size, and business model. Comparing a company's metrics to its competitors or industry benchmarks can provide a more meaningful analysis. Additionally, trends over time can help identify patterns and potential areas of concern. It is important to note that financial performance metrics should not be analyzed in isolation. They should be considered alongside other factors such as market conditions, industry trends, and qualitative aspects of the company's operations. A comprehensive analysis of financial statements, including the income statement, balance sheet, and cash flow statement, is necessary to gain a holistic understanding of a company's financial performance. By utilizing financial performance metrics effectively, investors, analysts, and stakeholders can make informed decisions about investing in a company, assessing its financial health, and evaluating its potential for growth and profitability. These metrics serve as valuable tools for understanding the financial performance of a company and are crucial for making sound financial decisions. 7.2 Comparative Analysis. Comparative analysis is a powerful tool used by investors, analysts, and financial professionals to gain insights into a company's financial performance over time. By comparing financial statements from different periods, such as year-over-year or quarter-over-quarter, analysts can identify trends, patterns, and changes in a company's financial health. This analysis helps stakeholders make informed decisions and evaluate the effectiveness of a company's strategies and operations. Importance of comparative analysis. Comparative analysis provides a historical perspective on a company's financial performance, allowing stakeholders to assess its progress and identify areas of improvement. It helps answer questions such as trend identification. Comparative analysis enables stakeholders to identify trends in a company's financial performance. By comparing financial statements over multiple periods, they can determine if the company's revenue, expenses, and profitability are increasing, decreasing, or remaining stable. This information is crucial for understanding the company's growth potential and financial stability. Performance evaluation. Comparative analysis allows stakeholders to evaluate a company's performance relative to its competitors or industry benchmarks. By comparing key financial ratios, such as liquidity, profitability, and solvency ratios, stakeholders can assess how well the company is performing compared to its peers. This analysis helps identify areas where the company is excelling or lagging behind, providing insights for strategic decision-making. Forecasting and planning. Comparative analysis helps stakeholders forecast future financial performance based on historical trends. By analyzing past financial statements, stakeholders can identify patterns and make informed projections about the company's future revenue, expenses, and profitability. This information is valuable for budgeting, setting financial goals, and developing strategic plans. Identifying financial strengths and weaknesses. Comparative analysis allows stakeholders to identify a company's financial strengths and weaknesses. By comparing financial statements over time, they can pinpoint areas where the company is performing well and areas that require improvement. This analysis helps stakeholders focus their efforts on enhancing the company's financial health and mitigating potential risks. Key steps in comparative analysis. To conduct a comprehensive comparative analysis, stakeholders should follow these key steps. Select the time period. Determine the time period for comparison, such as year-over-year, quarter-over-quarter, or multiple years. The choice of time period depends on the specific analysis objectives and the availability of financial statements. Gather financial statements. Collect the financial statements for the selected time period. These statements include the balance sheet, income statement, and cash flow statement. Ensure that the financial statements are prepared using consistent accounting principles and standards. Normalize the data. Normalize the financial data to ensure comparability. Adjust for any extraordinary or non-recurring items that may distort the analysis. For example, exclude one-time gains or losses, discontinued operations, or accounting changes. Calculate key financial ratios. Calculate relevant financial ratios to assess the company's performance. Common ratios used in comparative analysis include liquidity ratios, e.g., current ratio, quick ratio, profitability ratios, e.g., gross profit margin, net profit margin, and solvency ratios, e.g., debt to equity ratio, interest coverage ratio. Analyze trends and patterns. Analyze the financial statements and ratios to identify trends and patterns. Look for changes in revenue, expenses, profitability, and financial position over time. Assess the impact of external factors, such as economic conditions or industry trends, on the company's performance. Compare with peers and benchmarks. Compare the company's financial performance with its industry peers and benchmarks. This analysis provides insights into the company's relative position and helps identify areas of competitive advantage or weakness. Draw conclusions and make recommendations. Based on the comparative analysis, draw conclusions about the company's financial performance and identify areas for improvement. Make recommendations for strategic actions that can enhance the company's financial health and performance. Limitations of comparative analysis. While comparative analysis is a valuable tool, it is important to consider its limitations. Limited historical data. Comparative analysis relies on historical financial data, which may not capture the current or future dynamics of a company. It is essential to supplement comparative analysis with other forms of analysis, such as industry research and qualitative assessments. Influence of external factors. Comparative analysis may not fully account for the impact of external factors, such as changes in the regulatory environment, economic conditions, or industry trends. Stakeholders should consider these factors when interpreting the results of comparative analysis. Accounting changes and restatements. Comparative analysis may be affected by accounting changes or restatements. If a company changes its accounting policies or restates its financial statements, it can distort the comparability of the data. Stakeholders should be aware of any such changes and adjust their analysis accordingly. Differences in reporting standards. Comparative analysis may be challenging when comparing financial statements of companies operating in different countries or regions. Differences in reporting standards and accounting practices can affect the comparability of financial data. Stakeholders should be cautious when making cross-country or cross-regional comparisons. Despite these limitations, comparative analysis remains a valuable tool for evaluating a company's financial performance and making informed decisions. By analyzing trends, patterns, and changes over time, stakeholders can gain valuable insights into a company's financial health and identify areas for improvement. 7.3 Trend Analysis. Trend analysis is a powerful tool used by investors, analysts, and financial professionals to evaluate the performance of a company over a period of time. It involves analyzing financial data from multiple periods to identify patterns, trends, and changes in key financial metrics. By examining these trends, stakeholders can gain valuable insights into a company's financial health, growth potential, and overall performance. Importance of trend analysis. Trend analysis is crucial because it allows stakeholders to understand the direction and magnitude of changes in a company's financial performance. By comparing financial data from different periods, analysts can identify patterns and trends that may not be apparent when looking at individual financial statements. This analysis helps stakeholders make informed decisions about investing, lending, or partnering with a company. Identifying long-term performance. One of the primary objectives of trend analysis is to identify a company's long-term performance. By examining financial data over several years, stakeholders can determine whether a company is growing, stagnating, or declining. For example, by comparing revenue growth rates over a 5-year period, investors can assess whether a company is consistently increasing its sales or experiencing fluctuations. Evaluating profitability. Trend analysis is also useful for evaluating a company's profitability over time. By examining trends in key profitability ratios such as gross profit margin, operating profit margin, and net profit margin, stakeholders can assess whether a company's profitability is improving or deteriorating. This information is crucial for investors and creditors who want to ensure that a company can generate sustainable profits. Assessing efficiency. Efficiency is another important aspect of trend analysis. By analyzing trends in efficiency ratios such as inventory turnover, receivables turnover, and asset turnover, stakeholders can evaluate how effectively a company is utilizing its resources. Increasing efficiency ratios over time indicate that a company is becoming more productive and utilizing its assets more effectively. Monitoring liquidity. Trend analysis is also valuable for monitoring a company's liquidity position. By examining trends in liquidity ratios such as current ratio and quick ratio, stakeholders can assess whether a company has sufficient short-term assets to cover its short-term liabilities. A declining trend in liquidity ratios may indicate potential liquidity issues, while an improving trend suggests a healthier financial position. Tracking debt levels. Trend analysis helps stakeholders track a company's debt levels over time. By analyzing trends in debt ratios such as debt-to-equity ratio and interest coverage ratio, stakeholders can evaluate a company's ability to manage its debt obligations. Increasing debt ratios may indicate higher financial risk, while decreasing ratios suggest improved debt management. Analyzing investment returns. Trend analysis is also useful for evaluating a company's investment returns. By examining trends in return on assets (ROA) and return on equity (ROE), stakeholders can assess how effectively a company is generating returns from its assets and equity. Increasing trends in these ratios indicate improving profitability and efficiency, while declining trends may raise concerns about the company's performance. Limitations of trend analysis. While trend analysis provides valuable insights, it is important to consider its limitations. External factors such as changes in the industry, economic conditions, or regulatory environment can significantly impact a company's financial performance. Therefore, trend analysis should be used in conjunction with other analytical tools and qualitative information to gain a comprehensive understanding of a company's performance. Conclusion. Trend analysis is a powerful tool that allows stakeholders to evaluate a company's financial performance over time. By examining trends in key financial metrics, stakeholders can identify patterns, assess profitability, evaluate efficiency, monitor liquidity, track debt levels, and analyze investment returns. However, it is important to consider the limitations of trend analysis and use it in conjunction with other analytical tools to make well-informed decisions. By leveraging trend analysis effectively, stakeholders can gain valuable insights into a company's financial health and make informed decisions about investing, lending, or partnering with the company. 7.4 Benchmarking. Benchmarking is a valuable tool for evaluating financial performance and comparing it to industry standards and competitors. By analyzing key financial ratios and metrics, benchmarking allows businesses to identify areas of strength and weakness and make informed decisions to improve their financial performance. Understanding benchmarking. Benchmarking involves comparing a company's financial performance to industry averages, competitors, or best practices. It provides a benchmark or reference point against which a company can measure its own performance. By analyzing financial ratios and metrics, businesses can gain insights into their relative position in the market and identify areas for improvement. Benchmarking can be done in various ways, including internal benchmarking. This involves comparing a company's financial performance over time. By analyzing trends and changes in financial ratios and metrics, businesses can assess their progress and identify areas where they have improved or declined. Competitive benchmarking. This involves comparing a company's financial performance to its direct competitors. By analyzing industry averages and competitors' financial statements, businesses can gain insights into their relative position in the market and identify areas where they are outperforming or underperforming. Functional benchmarking. This involves comparing a company's financial performance to companies in different industries but with similar functions or processes. By analyzing best practices in other industries, businesses can identify opportunities for improvement and implement strategies to enhance their financial performance. Benefits of benchmarking. Benchmarking offers several benefits for businesses. Identifying strengths and weaknesses. By comparing financial performance to industry standards and competitors, benchmarking helps businesses identify areas of strength and weakness. This allows them to focus on improving weak areas and leveraging their strengths to gain a competitive advantage. Setting realistic goals. Benchmarking provides businesses with a realistic reference point for setting financial goals. By understanding industry averages and best practices, companies can set achievable targets and measure their progress against them. Improving financial performance. Benchmarking helps businesses identify areas for improvement and implement strategies to enhance their financial performance. By learning from industry leaders and competitors, companies can adopt best practices and optimize their operations. Gaining competitive insights. Benchmarking allows businesses to gain insights into their relative position in the market. By comparing financial ratios and metrics to competitors, companies can identify areas where they are outperforming or underperforming and adjust their strategies accordingly. Enhancing decision-making. Benchmarking provides businesses with valuable information for making informed decisions. By analyzing industry averages and competitors' financial statements, companies can evaluate the potential impact of different strategies and choose the most effective course of action. Key financial ratios for benchmarking. When benchmarking financial performance, certain key ratios and metrics are commonly used. These ratios provide insights into a company's liquidity, profitability, efficiency, and solvency. Some of the key financial ratios for benchmarking include liquidity ratios. Liquidity ratios measure a company's ability to meet short-term obligations. Common liquidity ratios include the current ratio, quick ratio, and cash ratio. By comparing these ratios to industry averages, businesses can assess their ability to cover short-term liabilities. Profitability ratios. Profitability ratios measure a company's ability to generate profits. Common profitability ratios include gross profit margin, operating profit margin, net profit margin, return on assets ROA, and return on equity ROE. By comparing these ratios to industry averages, businesses can evaluate their profitability relative to competitors. Efficiency ratios. Efficiency ratios measure a company's ability to utilize its assets and resources effectively. Common efficiency ratios include asset turnover ratio, inventory turnover ratio, and accounts receivable turnover ratio. By comparing these ratios to industry averages, businesses can assess their operational efficiency. Solvency ratios. Solvency ratios measure a company's ability to meet long-term obligations. Common solvency ratios include debt-to-equity ratio, interest coverage ratio, and debt ratio. By comparing these ratios to industry averages, businesses can evaluate their long-term financial stability. Limitations of benchmarking. While benchmarking can provide valuable insights, it is important to consider its limitations. Industry differences. Different industries have unique characteristics and operating models. Benchmarking across industries may not provide accurate comparisons due to variations in business models, market conditions, and regulatory environments. Data availability. Access to accurate and reliable financial data for benchmarking purposes can be a challenge. Companies may not disclose detailed financial information, making it difficult to obtain accurate industry averages for comparison. Size and scale. Companies of different sizes and scales may have different financial ratios and metrics. Benchmarking against larger or smaller companies may not provide meaningful comparisons. Changing industry dynamics. Industries evolve over time, and benchmarking against historical data may not reflect current market conditions. It is important to consider the impact of industry trends and changes when interpreting benchmarking results. Despite these limitations, benchmarking remains a valuable tool for evaluating financial performance and identifying areas for improvement. By analyzing key financial ratios and metrics and comparing them to industry averages and competitors, businesses can make informed decisions to enhance their financial performance and gain a competitive edge. 8. Assessing financial health. 8.1 Financial health indicators. When assessing the financial health of a company, it is crucial to analyze various indicators that provide insights into its financial stability, performance, and ability to meet its financial obligations. These indicators help investors, creditors, and other stakeholders evaluate the overall financial well-being of the company. By examining these financial health indicators, stakeholders can make informed decisions about investing, lending, or engaging in business relationships with the company. Liquidity ratios. Liquidity ratios are a set of financial health indicators that measure a company's ability to meet its short-term obligations. These ratios assess the company's ability to convert its assets into cash to cover its current liabilities. The most commonly used liquidity ratios include the current ratio and the quick ratio. The current ratio is calculated by dividing the company's current assets by its current liabilities. It provides an indication of the company's ability to pay off its short-term obligations using its current assets. A higher current ratio indicates a better ability to meet short-term obligations. The quick ratio, also known as the acid test ratio, is a more stringent measure of liquidity. It excludes inventory from current assets since inventory may not be easily converted into cash. The quick ratio is calculated by dividing the sum of cash, marketable securities, and accounts receivable by current liabilities. A higher quick ratio suggests a stronger ability to meet short-term obligations without relying on inventory. Solvency ratios. Solvency ratios assess a company's long-term financial health and its ability to meet its long-term obligations. These ratios provide insights into the company's capital structure and its ability to generate sufficient cash flow to cover its long-term debt. The two commonly used solvency ratios are the debt-to-equity ratio and the interest coverage ratio. The debt-to-equity ratio measures the proportion of debt and equity financing used by the company. It is calculated by dividing the total debt by the total equity. A higher debt-to-equity ratio indicates a higher level of financial risk and reliance on debt financing. The interest coverage ratio evaluates the company's ability to meet its interest payments on outstanding debt. It is calculated by dividing the company's earnings before interest and taxes (EBIT) by its interest expense. A higher interest coverage ratio suggests a better ability to cover interest payments and indicates a lower risk of defaulting on debt obligations. Profitability ratios. Profitability ratios assess a company's ability to generate profits from its operations. These ratios provide insights into the company's efficiency, effectiveness, and overall financial performance. The commonly used profitability ratios include the gross profit margin, operating profit margin, and net profit margin. The gross profit margin measures the percentage of revenue that remains after deducting the cost of goods sold. It is calculated by dividing the gross profit by revenue. A higher gross profit margin indicates better cost management and pricing strategies. The operating profit margin measures the percentage of revenue that remains after deducting both the cost of goods sold and operating expenses. It is calculated by dividing the operating profit by revenue. A higher operating profit margin suggests better operational efficiency and profitability. The net profit margin measures the percentage of revenue that remains after deducting all expenses, including taxes and interest. It is calculated by dividing the net profit by revenue. A higher net profit margin indicates better overall profitability and effective management of expenses. Efficiency ratios. Efficiency ratios assess a company's ability to utilize its assets and resources effectively to generate revenue and profits. These ratios provide insights into the company's operational efficiency and effectiveness. The commonly used efficiency ratios include the asset turnover ratio and the inventory turnover ratio. The asset turnover ratio measures the company's ability to generate revenue from its total assets. It is calculated by dividing revenue by total assets. A higher asset turnover ratio indicates better utilization of assets to generate revenue. The inventory turnover ratio measures the number of times a company sells and replaces its inventory within a given period. It is calculated by dividing the cost of goods sold by the average inventory. A higher inventory turnover ratio suggests efficient inventory management and faster inventory turnover. By analyzing these financial health indicators, stakeholders can gain a comprehensive understanding of a company's financial position, performance, and ability to meet its financial obligations. However, it is important to note that these indicators should not be considered in isolation. They should be analyzed in conjunction with other factors such as industry benchmarks, market conditions, and qualitative information to make well-informed decisions. 8.2 Working Capital Management. Working capital management is a crucial aspect of financial management for any organization. It involves managing the company's short-term assets and liabilities to ensure smooth operations and maintain financial stability. In this section, we will explore the importance of working capital management, its components, and strategies for effective management. Importance of working capital management. Working capital is the difference between a company's current assets and current liabilities. It represents the funds available to cover day-to-day operational expenses and short-term obligations. Effective working capital management is essential for several reasons. Liquidity. Adequate working capital ensures that a company has enough cash and other liquid assets to meet its short-term obligations promptly. It allows the organization to pay suppliers, employees, and other creditors on time, maintaining good relationships and avoiding disruptions in the supply chain. Operating efficiency. Efficient working capital management helps optimize the utilization of resources. By effectively managing inventory, accounts receivable, and accounts payable, a company can minimize idle cash, reduce carrying costs, and improve overall operational efficiency. Profitability. Proper management of working capital can enhance profitability. By reducing the cash conversion cycle, the time it takes to convert inventory into cash, a company can generate more cash flow and potentially increase its profitability. Risk management. Inadequate working capital can lead to financial distress and even bankruptcy. By maintaining sufficient working capital, a company can mitigate the risk of defaulting on its short-term obligations and ensure its long-term viability. Components of working capital. Working capital is composed of various components that reflect the company's short-term financial position. The key components include cash and cash equivalents. This includes cash on hand, demand deposits, and highly liquid investments that can be readily converted into cash. Accounts receivable. These are amounts owed to the company by its customers for goods or services provided on credit. Efficient management of accounts receivable involves timely collection to minimize the risk of bad debts. Inventory. Inventory represents the goods held by a company for sale or production. Effective inventory management involves balancing the need to meet customer demand while minimizing carrying costs and the risk of obsolescence. Accounts payable. Accounts payable are the amounts owed by the company to its suppliers for goods or services received on credit. Managing accounts payable involves optimizing payment terms to maintain good relationships with suppliers while maximizing cash flow. Strategies for working capital management. To effectively manage working capital, companies employ various strategies tailored to their specific needs and industry dynamics. Some common strategies include cash flow forecasting. Accurate cash flow forecasting helps companies anticipate their short-term cash needs and plan accordingly. By analyzing historical data and considering future business activities, companies can identify potential cash shortfalls and take proactive measures to manage their working capital. Inventory optimization. Implementing inventory management techniques such as just-in-time (JIT) inventory systems and demand forecasting can help minimize inventory carrying costs while ensuring sufficient stock availability to meet customer demand. Accounts receivable management. Companies can improve their cash flow by implementing effective credit policies, conducting credit checks on customers, and promptly following up on overdue payments. Offering discounts for early payment can also incentivize customers to settle their accounts promptly. Supplier relationship management. Building strong relationships with suppliers can lead to favorable payment terms, discounts, and improved overall supply chain efficiency. Negotiating longer payment terms or implementing vendor-managed inventory systems can help optimize cash flow. Working capital financing. In situations where additional working capital is required, companies can explore various financing options. These may include short-term loans, lines of credit, factoring, or trade credit arrangements with suppliers. By implementing these strategies and continuously monitoring and adjusting their working capital management practices, companies can optimize their financial position, improve operational efficiency, and enhance their overall financial health. In conclusion, working capital management plays a vital role in maintaining the financial stability and operational efficiency of a company. By effectively managing the components of working capital and implementing appropriate strategies, organizations can ensure sufficient liquidity, optimize resource utilization, and mitigate financial risks. Regular monitoring and analysis of working capital metrics are essential to identify areas for improvement and make informed decisions to enhance the company's financial health. 8.3 Debt management. Debt management is a crucial aspect of financial analysis and plays a significant role in assessing the financial health of a company. It involves evaluating a company's ability to manage its debt obligations effectively and make timely payments to creditors. By analyzing a company's debt management practices, investors and stakeholders can gain insights into its financial stability and risk profile. Understanding debt. Before delving into debt management, it is essential to understand the concept of debt. Debt refers to the money borrowed by a company from external sources, such as banks, financial institutions, or bondholders, to finance its operations or investments. It is a common practice for companies to utilize debt as a means of raising capital, especially for large-scale projects or expansion plans. Debt can take various forms, including bank loans, bonds, debentures, and lines of credit. Each type of debt has its own terms and conditions, such as interest rates, repayment schedules, and collateral requirements. It is crucial for companies to carefully manage their debt to ensure they can meet their financial obligations and maintain a healthy financial position. Debt management ratios. To assess a company's debt management practices, analysts and investors rely on various debt management ratios. These ratios provide insights into a company's ability to generate sufficient cash flow to service its debt and the level of risk associated with its debt obligations. Let's explore some key debt management ratios. Debt-to-equity ratio. This ratio compares a company's total debt to its shareholders' equity and indicates the proportion of debt financing relative to equity financing. A higher debt-to-equity ratio suggests a higher level of financial risk, as the company relies more on borrowed funds. Debt ratio. The debt ratio measures the proportion of a company's assets that are financed by debt. It is calculated by dividing total debt by total assets. A higher debt ratio indicates a higher level of financial leverage and potential risk. Interest coverage ratio. This ratio assesses a company's ability to meet its interest payments on outstanding debt. It is calculated by dividing earnings before interest and taxes (EBIT) by interest expense. A higher interest coverage ratio indicates a company's ability to generate sufficient earnings to cover its interest obligations. Debt service coverage ratio. The debt service coverage ratio evaluates a company's ability to meet its debt obligations, including both principal and interest payments. It is calculated by dividing the company's operating income by its total debt service, principal and interest payments. A higher ratio indicates a better ability to service debt. Debt to EBITDA ratio. This ratio compares a company's total debt to its earnings before interest, taxes, depreciation, and amortization (EBITDA). It provides insights into a company's ability to repay its debt using its operating income. A higher ratio suggests a higher level of financial risk. Importance of debt management. Effective debt management is crucial for several reasons. Financial stability. By managing debt effectively, companies can maintain financial stability and reduce the risk of default. This enhances their reputation and creditworthiness, making it easier to access additional financing when needed. Cost of capital. Debt management plays a significant role in determining a company's cost of capital. By maintaining a healthy debt profile, companies can negotiate favorable interest rates and terms, reducing their overall cost of borrowing. Investor confidence. Investors closely monitor a company's debt management practices to assess its financial health and stability. A well-managed debt structure instills confidence in investors, potentially leading to increased investment and shareholder value. Flexibility. Effective debt management provides companies with the flexibility to pursue growth opportunities, make strategic investments, and weather economic downturns. By maintaining an optimal debt level, companies can allocate resources efficiently and adapt to changing market conditions. Strategies for debt management. To effectively manage debt, companies can employ various strategies. Debt refinancing. Companies can refinance their existing debt to take advantage of lower interest rates or extend the repayment period. This can help reduce interest expenses and improve cash flow. Debt restructuring. In situations where a company is facing financial distress, debt restructuring may be necessary. This involves renegotiating the terms of existing debt agreements with creditors to alleviate financial pressure and improve the company's ability to meet its obligations. Debt repayment prioritization. Companies should prioritize debt repayment based on the terms and conditions of each debt instrument. By focusing on high interest or short-term debt, companies can reduce interest expenses and improve their overall debt profile. Cash flow management. Effective cash flow management is crucial for debt management. Companies should closely monitor their cash flow to ensure they have sufficient funds to meet debt obligations and avoid default. Diversification of funding sources. Relying on a single source of funding can increase a company's risk exposure. By diversifying their funding sources, companies can reduce their dependence on a particular lender or type of debt instrument. Conclusion. Debt management is a critical aspect of financial analysis and plays a vital role in assessing a company's financial health and stability. By evaluating a company's debt management practices and analyzing key debt management ratios, investors and stakeholders can gain valuable insights into its ability to meet its debt obligations and manage financial risk effectively. Effective debt management not only enhances a company's financial stability but also instills confidence in investors and provides the flexibility to pursue growth opportunities. 8.4 Profitability and efficiency. Profitability and efficiency are two key aspects of assessing the financial health of a company. Profitability measures the ability of a company to generate profits from its operations, while efficiency measures how effectively a company utilizes its resources to generate those profits. By analyzing profitability and efficiency ratios, investors and stakeholders can gain valuable insights into a company's financial performance and its ability to generate sustainable returns. Profitability ratios. Profitability ratios provide an indication of a company's ability to generate profits relative to its sales, assets, and equity. These ratios help investors assess a company's profitability and its ability to generate returns for its shareholders. Here are some commonly used profitability ratios. Gross profit margin. This ratio measures the percentage of revenue that remains after deducting the cost of goods sold. A higher gross profit margin indicates that the company is effectively managing its production costs and pricing its products or services competitively. Operating profit margin. This ratio measures the percentage of revenue that remains after deducting both the cost of goods sold and operating expenses. It reflects the company's ability to generate profits from its core operations. Net profit margin. This ratio measures the percentage of revenue that remains after deducting all expenses, including taxes and interest. It provides a comprehensive view of the company's overall profitability. Return on assets (ROA). ROA measures the company's ability to generate profits relative to its total assets. It indicates how efficiently the company utilizes its assets to generate profits. Return on equity (ROE) measures the company's ability to generate profits relative to its shareholders' equity. It reflects the return on investment for shareholders and indicates how effectively the company utilizes shareholder funds. Analyzing these profitability ratios helps investors understand the company's ability to generate profits and its overall financial performance. However, it is important to compare these ratios with industry benchmarks and historical data to gain a more meaningful perspective. Efficiency ratios. Efficiency ratios assess how effectively a company utilizes its resources to generate profits. These ratios provide insights into the company's operational efficiency, asset management, and inventory management. Here are some commonly used efficiency ratios. Asset turnover ratio. This ratio measures the company's ability to generate sales relative to its total assets. It indicates how efficiently the company utilizes its assets to generate revenue. Inventory turnover ratio. This ratio measures the number of times a company sells and replaces its inventory within a given period. It reflects how effectively the company manages its inventory levels and avoids overstocking or understocking. Accounts receivable turnover ratio. This ratio measures the number of times a company collects its accounts receivable within a given period. It indicates how efficiently the company manages its credit sales and collects payments from customers. Days Sales Outstanding (DSO). DSO measures the average number of days it takes for a company to collect payments from its customers. A lower DSO indicates that the company collects payments more quickly, improving its cash flow and liquidity. Fixed asset turnover ratio. This ratio measures the company's ability to generate sales relative to its fixed assets. It indicates how efficiently the company utilizes its fixed assets to generate revenue. Efficiency ratios help investors assess how well a company manages its resources and operations. By analyzing these ratios, investors can identify areas where the company may be experiencing inefficiencies or operational challenges. Interpreting profitability and efficiency ratios. When interpreting profitability and efficiency ratios, it is important to consider the industry norms and compare the ratios with competitors and historical data. A ratio that appears low in absolute terms may still be considered favorable if it is higher than the industry average or shows improvement over time. Investors should also consider the company's business model and industry dynamics. Different industries have varying levels of profitability and efficiency due to factors such as competition, market conditions, and regulatory constraints. Therefore, it is crucial to compare ratios within the context of a specific industry. Furthermore, it is important to analyze profitability and efficiency ratios in conjunction with other financial metrics and qualitative factors. A company may have high profitability ratios but face challenges in terms of sustainability or growth prospects. Therefore, a comprehensive analysis of the company's financial statements, industry position, and future prospects is essential for making informed investment decisions. In conclusion, profitability and efficiency ratios provide valuable insights into a company's financial performance and its ability to generate sustainable returns. By analyzing these ratios, investors can assess the company's profitability, operational efficiency, and resource utilization. However, it is crucial to interpret these ratios in the context of industry benchmarks, historical data, and qualitative factors to gain a comprehensive understanding of the company's financial health. 9. Detecting financial manipulation. 9.1 Red flags in financial statements. When analyzing financial statements, it is important to be aware of potential red flags that may indicate financial manipulation or misrepresentation. Red flags are warning signs that suggest there may be issues with the accuracy or reliability of the financial information presented in the statements. By identifying these red flags, investors and analysts can exercise caution and conduct further investigation to ensure the integrity of the financial statements. In this section, we will discuss some common red flags to watch out for when reading annual reports. Inconsistent or unusual trends. One of the first things to look for when reviewing financial statements is any inconsistent or unusual trends. This can include significant fluctuations in revenue, expenses, or other key financial metrics from year to year. While some variation is expected, drastic changes without a clear explanation may indicate manipulation or misrepresentation of financial data. For example, a sudden spike in revenue or a sharp decrease in expenses without any corresponding explanation could be a red flag. Unexplained changes in accounting policies. Changes in accounting policies can also raise red flags. Companies may change their accounting methods or policies for legitimate reasons, such as adopting new accounting standards. However, if a company frequently changes its accounting policies or makes significant changes without a clear rationale, it may be an indication of an attempt to manipulate financial results. Investors should carefully review the notes to the financial statements to understand the reasons behind any changes in accounting policies. Unusual or excessive related party transactions. Related party transactions refer to transactions between a company and its affiliates, such as subsidiaries, joint ventures, or entities controlled by key management personnel. While related party transactions are not inherently problematic, excessive or unusual transactions with related parties can be a red flag. These transactions may be used to manipulate financial results by inflating revenues or understating expenses. Investors should pay close attention to the disclosure of related party transactions in the financial statements and assess their impact on the company's financial performance. Aggressive revenue recognition practices. Revenue recognition is a critical area to examine when analyzing financial statements. Aggressive revenue recognition practices involve recognizing revenue prematurely or inflating revenue figures to create a more favorable financial picture. Red flags in revenue recognition can include recognizing revenue before it is earned, booking revenue from long-term contracts upfront, or recognizing revenue from questionable sources. Investors should carefully review the revenue recognition policies and practices disclosed in the financial statements to ensure they are in line with industry norms and accounting standards. Unexplained changes in inventory levels. Inventory is an important asset for many companies, particularly those in the manufacturing or retail sectors. Significant and unexplained changes in inventory levels can be a red flag. For example, a sudden increase in inventory levels without a corresponding increase in sales may indicate that the company is inflating its inventory to overstate its financial position. Conversely, a significant decrease in inventory levels without a clear explanation may suggest that the company is trying to hide poor sales performance. Investors should analyze the inventory turnover ratio and compare it to industry benchmarks to assess the reasonableness of inventory levels. Excessive debt levels. High levels of debt can be a cause for concern, especially if a company is struggling to generate sufficient cash flow to service its debt obligations. Excessive debt can lead to financial distress and may indicate poor financial health. Investors should carefully review the company's debt levels, debt-to-equity ratio, and interest coverage ratio to assess its ability to manage its debt. A consistently increasing debt burden or a high debt-to-equity ratio relative to industry peers may be a red flag. Inadequate disclosure or lack of transparency. Lastly, inadequate disclosure or a lack of transparency in the financial statements can be a red flag. Companies should provide clear and comprehensive information about their financial performance, accounting policies, significant risks, and other relevant factors that may impact their financial position. If a company fails to provide sufficient disclosure or if the information provided is vague or inconsistent, it may indicate an attempt to hide unfavorable information or manipulate financial results. Investors should carefully review the footnotes and other disclosures in the financial statements to ensure they provide a complete and transparent picture of the company's financial position. In conclusion, when reading annual reports and analyzing financial statements, it is crucial to be aware of potential red flags that may indicate financial manipulation or misrepresentation. By identifying these warning signs, investors and analysts can exercise caution and conduct further investigation to ensure the accuracy and reliability of the financial information. Some common red flags include inconsistent or unusual trends, unexplained changes in accounting policies, excessive related party transactions, aggressive revenue recognition practices, unexplained changes in inventory levels, excessive debt levels, and inadequate disclosure or lack of transparency. By being vigilant and thorough in their analysis, investors can make more informed decisions and protect themselves from potential financial risks. 9.2 Creative Accounting Techniques. Creative accounting techniques refer to the practices used by companies to manipulate their financial statements in order to present a more favorable picture of their financial performance and position. These techniques involve bending accounting rules and principles within the boundaries of legality to achieve specific objectives, such as increasing profits, improving liquidity ratios, or reducing debt levels. While some creative accounting practices may be within the limits of acceptable accounting standards, others can be misleading and unethical. Revenue recognition manipulation. One of the most common creative accounting techniques is revenue recognition manipulation. Companies may manipulate the timing of revenue recognition to inflate their reported revenues. This can be done by recognizing revenue prematurely or delaying its recognition. For example, a company may record sales before the goods are actually delivered or services are rendered, or they may delay recognizing revenue until a later period to meet specific financial targets. By manipulating revenue recognition, companies can create the illusion of consistent growth and profitability. Expense manipulation. Expense manipulation involves manipulating the timing or classification of expenses to either inflate or deflate reported earnings. Companies may delay recognizing expenses to future periods or accelerate the recognition of expenses to the current period. By doing so, they can either boost current earnings or reduce them to meet specific financial targets. Expense manipulation can also involve reclassifying certain expenses as capital expenditures, which are then depreciated over time, resulting in lower reported expenses and higher profits in the short term. Off-balance sheet financing. Off-balance sheet financing refers to the practice of keeping certain assets, liabilities, or transactions off the company's balance sheet. This technique allows companies to hide debt, reduce reported liabilities, or inflate reported assets. Off-balance sheet financing can be achieved through various methods, such as operating leases, special purpose entities, or complex financial instruments. By keeping certain financial obligations off the balance sheet, companies can present a healthier financial position than what actually exists. Related party transactions. Related party transactions involve transactions between a company and its related parties, such as its subsidiaries, affiliates, or key management personnel. Creative accounting techniques can be employed in related party transactions to manipulate financial statements. For example, a company may engage in transactions with related parties at favorable terms, such as selling assets at below market prices or providing loans at low interest rates. These transactions can artificially inflate profits or understate liabilities, giving a distorted view of the company's financial performance and position. Cookie jar reserves. Cookie jar reserves are discretionary reserves set aside by companies during profitable periods to be used in future periods to smooth out earnings. This technique involves manipulating the amount of reserves to artificially inflate or deflate reported earnings. During periods of high profitability, companies may overstate their reserves, creating a cookie jar of excess reserves. These reserves can then be used in future periods to offset lower earnings, giving the impression of consistent performance and stability. Channel stuffing. Channel stuffing is a technique used by companies to artificially boost sales and inflate revenues by shipping excessive amounts of products to distributors or retailers. This practice allows companies to recognize revenue immediately, even though the products may not have been sold to end customers. By pushing excess inventory onto the distribution channel, companies can create the illusion of strong demand and higher sales figures. However, this can lead to future periods of weak sales and potential write-offs when the excess inventory is eventually returned or sold at discounted prices. Window dressing. Window dressing refers to the practice of making cosmetic changes to financial statements to present a more favorable picture of a company's financial position. This can involve selectively disclosing positive information while omitting negative information, manipulating financial ratios, or using accounting techniques to temporarily improve key financial metrics. Window dressing is often done at the end of reporting periods to impress investors, lenders, or other stakeholders. However, it can be misleading and does not provide an accurate representation of the company's true financial health. It is important for investors, analysts, and other stakeholders to be aware of these creative accounting techniques and to critically analyze financial statements to identify any potential manipulation. Understanding the red flags and warning signs associated with creative accounting can help stakeholders make more informed decisions and avoid potential financial pitfalls. Annual reports are comprehensive documents that provide a detailed overview of a company's financial performance and operations over a specific period, usually 1 year. These reports are essential for investors, analysts, and other stakeholders to gain insights into a company's financial health and make informed decisions. One crucial aspect of analyzing annual reports is understanding the accounting policies employed by the company. Importance of analyzing accounting policies. Analyzing accounting policies is crucial because they determine how a company records and presents its financial transactions. Accounting policies are a set of guidelines and principles that govern the preparation and presentation of financial statements. They ensure consistency and comparability across different periods and companies within the same industry. By examining the accounting policies disclosed in the annual report, investors can assess the quality and reliability of the financial statements. Understanding the accounting policies helps investors identify potential risks, evaluate the company's financial performance accurately, and make informed investment decisions. Key elements of accounting policies. When analyzing accounting policies, there are several key elements to consider. 1. Revenue recognition. Revenue recognition is a critical accounting policy that determines when and how a company recognizes revenue from its operations. Different industries may have specific guidelines for revenue recognition. For example, software companies may recognize revenue over time as the product is delivered, while retail companies may recognize revenue at the point of sale. Investors should carefully review the revenue recognition policy to ensure it aligns with industry standards and is not overly aggressive or conservative. Aggressive revenue recognition practices may artificially inflate revenue figures, while conservative practices may understate revenue. 2. Expense recognition. Expense recognition policies dictate how a company records and recognizes expenses in its financial statements. Companies may choose to recognize expenses immediately or spread them over a specific period, depending on the nature of the expense. Investors should evaluate the expense recognition policy to ensure it is consistent with industry norms and does not manipulate earnings. Unusual or excessive deferral of expenses may inflate profits in the short term but can lead to future financial instability. 3. Inventory valuation. Inventory valuation policies determine how a company values its inventory for financial reporting purposes. Different methods, such as first in first out FIFO or last in first out LIFO, can significantly impact a company's reported profitability and financial position. Investors should understand the inventory valuation policy and assess its impact on the company's financial statements. They should also consider whether the chosen method is consistent with industry practices and whether any potential biases exist. 4. Depreciation and amortization. Depreciation and amortization policies govern how a company allocates the cost of its long-term assets over their useful lives. These policies can significantly impact a company's reported profitability and financial position. Investors should review the depreciation and amortization policy to ensure it is reasonable and consistent with industry standards. They should also consider the impact of any changes in the policy on the company's financial statements. 5. Leases and off-balance sheet items. Accounting policies related to leases and off-balance sheet items can have a significant impact on a company's financial position and risk profile. Investors should carefully review the disclosure related to leases and off-balance sheet items to understand the potential liabilities and risks associated with these arrangements. 6. Financial instruments and derivatives. Accounting policies related to financial instruments and derivatives can be complex and have a substantial impact on a company's reported financial position and risk exposure. Investors should review the accounting policies related to these instruments to understand how they are valued, recorded, and disclosed in the financial statements. Assessing the impact of accounting policies. When analyzing accounting policies, it is essential to assess their impact on the financial statements. Investors should consider the following factors. Consistency. Are the accounting policies consistently applied across different periods and comparable to industry peers? Materiality. Do the accounting policies have a significant impact on the financial statements? Are there any material changes in the policies from previous periods? Transparency. Are the accounting policies clearly disclosed in the annual report? Did they provide sufficient information for investors to understand their impact? Management's judgment. Are there any areas where management's judgment is required in applying the accounting policies? Are there any potential biases or risks associated with these judgments? By carefully analyzing the accounting policies disclosed in the annual report and assessing their impact on the financial statements, investors can gain a deeper understanding of a company's financial performance and make more informed investment decisions. It is crucial to consider the overall quality and reliability of the financial statements, as well as any potential risks or red flags that may arise from the accounting policies employed by the company. Annual reports are an essential source of information for investors, analysts, and other stakeholders interested in understanding a company's financial performance and prospects. These reports provide a comprehensive overview of a company's operations, financial statements, and management's discussion and analysis of the business. One crucial aspect of analyzing annual reports is identifying any potential earnings management practices. Earnings management refers to the manipulation of financial statements to present a more favorable picture of a company's financial performance. This manipulation can be done through various techniques, such as revenue recognition, expense manipulation, and asset valuation. Identifying earnings management requires a careful examination of the financial statements, footnotes, and other relevant information provided in the annual report. Here are some key areas to focus on when trying to identify potential earnings management. Revenue recognition. Revenue is a critical component of a company's financial performance. Look for any unusual or aggressive revenue recognition practices, such as recognizing revenue prematurely or manipulating the timing of revenue recognition. Pay attention to changes in revenue recognition policies or significant fluctuations in revenue growth rates. Expense manipulation. Expenses play a crucial role in determining a company's profitability. Analyze the trends and patterns in various expense categories, such as cost of goods sold, operating expenses, and research and development expenses. Look for any unusual or inconsistent changes in expense ratios or sudden decreases in expenses that seem unrealistic. Provision for bad debts. Companies often make provisions for bad debts to account for potential losses from customers who may default on their payments. Analyze the trends in the provision for bad debts and compare them to the company's historical data and industry benchmarks. Significant fluctuations or sudden changes in the provision for bad debts may indicate potential earnings management. Asset valuation. Companies value their assets, such as inventory, property, plant, and equipment, based on various accounting principles. Analyze the changes in asset valuation methods or significant write-offs of assets. Look for any indications of overvaluation or undervaluation of assets that may impact the company's reported earnings. Restructuring charges. Companies often incur restructuring charges when they undergo significant organizational changes, such as mergers, acquisitions, or downsizing. Analyze the nature and magnitude of restructuring charges and compare them to the company's strategic initiatives and industry norms. Excessive or frequent restructuring charges may be a sign of earnings management. Off-balance sheet items. Off-balance sheet items refer to financial obligations or assets that are not recorded on the company's balance sheet. Analyze the footnotes and disclosures to identify any significant off-balance sheet arrangements, such as lease commitments, contingent liabilities, or special purpose entities. These off-balance sheet items may impact the company's reported earnings and financial position. Related party transactions. Related party transactions involve transactions between a company and its affiliates, subsidiaries, or key management personnel. Analyze the footnotes and disclosures to identify any significant related party transactions and assess their impact on the company's financial statements. Related party transactions may be used to manipulate earnings or divert resources for personal gain. Changes in accounting policies. Companies may change their accounting policies from one year to another, which can impact the reported earnings. Analyze the footnotes and disclosures to identify any changes in accounting policies and assess their impact on the financial statements. Look for any changes that seem inconsistent or aimed at improving the reported earnings. Auditor's opinion. Pay attention to the auditor's opinion provided in the annual report. If the auditor raises concerns about the company's accounting practices or identifies any material misstatements, it may indicate potential earnings management. Look for any qualifications, limitations, or emphasis of matter paragraphs in the auditor's report. Management's discussion and analysis MD&A. The MD&A section of the annual report provides management's perspective on the company's financial performance and future prospects. Analyze the MD&A to identify any inconsistencies or overly optimistic projections that may indicate potential earnings management. It is important to note that identifying potential earnings management requires a thorough understanding of accounting principles, industry norms, and the company's specific circumstances. It is advisable to consult with financial professionals or conduct further research to validate any suspicions of earnings management. By carefully analyzing the financial statements, footnotes, and other relevant information provided in the annual report, investors and analysts can gain insights into a company's financial performance and identify any potential earnings management practices. This information is crucial for making informed investment decisions and assessing the overall financial health of a company. 10. Using financial statements for investment analysis. 10.1 Fundamental analysis. Fundamental analysis is a method used by investors to evaluate the intrinsic value of a company's stock and make investment decisions based on the company's financial statements and other relevant information. It involves analyzing various aspects of a company, such as its financial health, management performance, competitive position, and industry trends, to determine whether the stock is overvalued or undervalued. Importance of fundamental analysis. Fundamental analysis is crucial for investors as it provides a deeper understanding of a company's financial position and helps them make informed investment decisions. By examining a company's financial statements, investors can assess its profitability, growth potential, and overall financial health. This analysis allows investors to identify companies that are undervalued or have strong growth prospects, which can lead to potential investment opportunities. Key components of fundamental analysis. Financial statements. The primary source of information for fundamental analysis is a company's financial statements, including the balance sheet, income statement, and cash flow statement. These statements provide a comprehensive overview of a company's financial performance, liquidity, and cash flow. Ratio analysis. Ratio analysis is a key tool used in fundamental analysis to assess a company's financial health and performance. It involves calculating and analyzing various financial ratios, such as liquidity ratios, profitability ratios, and solvency ratios. These ratios help investors understand a company's ability to meet its short-term and long-term obligations, generate profits, and manage its finances effectively. Management performance. Evaluating the management team is an essential aspect of fundamental analysis. Investors assess the track record and competence of the company's management, their strategic decisions, and their ability to create value for shareholders. This analysis includes reviewing the company's corporate governance practices, executive compensation, and any potential conflicts of interest. Industry analysis. Understanding the industry in which a company operates is crucial for fundamental analysis. Investors analyze industry trends, competitive dynamics, and market conditions to assess a company's competitive position and growth potential. This analysis helps investors determine whether a company is well positioned to capitalize on industry opportunities or faces significant challenges. Economic factors. Fundamental analysis also considers broader economic factors that can impact a company's performance. Factors such as interest rates, inflation, GDP growth, and consumer sentiment can influence a company's revenue, costs, and profitability. Investors analyze these macroeconomic factors to assess the potential risks and opportunities for a company. Tools and techniques of fundamental analysis. Financial ratio analysis. As mentioned earlier, financial ratios play a crucial role in fundamental analysis. Investors use various ratios, such as the current ratio, debt-to-equity ratio, return on equity, and earnings per share, to assess a company's financial performance and compare it with industry peers. DCF valuation. Discounted cash flow (DCF) valuation is a widely used technique in fundamental analysis to estimate the intrinsic value of a company's stock. It involves projecting future cash flows and discounting them back to the present value using an appropriate discount rate. DCF valuation helps investors determine whether a stock is undervalued or overvalued. Comparable company analysis. In this analysis, investors compare the financial ratios and valuation multiples of a company with its industry peers. By identifying companies with similar business models and financial characteristics, investors can assess the relative valuation of a company and make investment decisions accordingly. Qualitative analysis. Fundamental analysis also involves qualitative factors, such as assessing a company's competitive advantage, brand strength, intellectual property, and market positioning. These qualitative factors provide insights into a company's long-term prospects and its ability to sustain its competitive edge. Limitations of fundamental analysis. While fundamental analysis provides valuable insights into a company's financial health, it has certain limitations that investors should be aware of. Subjectivity. Fundamental analysis involves making subjective judgments based on available information. Different analysts may interpret the same financial statements differently, leading to varying conclusions. Data limitations. Financial statements provide historical data, and future performance may not always align with past trends. Additionally, financial statements may not capture all relevant information, such as pending lawsuits or potential regulatory changes. Market inefficiencies. The stock market is not always efficient, meaning that stock prices may not always reflect a company's true value. Market sentiment, investor behavior, and other external factors can influence stock prices, leading to deviations from intrinsic value. Time and effort. Conducting thorough fundamental analysis requires significant time and effort. Investors need to analyze multiple financial statements, industry reports, and economic data to make informed decisions. This can be challenging for individual investors with limited resources. Despite these limitations, fundamental analysis remains a valuable tool for investors to assess the financial health and investment potential of a company. By combining quantitative analysis with qualitative insights, investors can make more informed investment decisions and navigate the complex world of financial markets. 10.2 Valuation Techniques. Valuation techniques are essential tools for investors and analysts to determine the intrinsic value of a company's stock or other financial assets. These techniques help in assessing whether a stock is overvalued, undervalued, or fairly priced in the market. By understanding the valuation techniques, investors can make informed investment decisions and identify potential opportunities for profitable investments. Discounted cash flow (DCF) analysis. One of the most widely used valuation techniques is the discounted cash flow (DCF) analysis. This method estimates the present value of a company's future cash flows by discounting them back to their current value. The DCF analysis takes into account the time value of money, which means that a dollar received in the future is worth less than a dollar received today. To perform a DCF analysis, analysts forecast the company's future cash flows based on its historical performance, industry trends, and market conditions. These cash flows are then discounted using an appropriate discount rate, such as the company's cost of capital or the weighted average cost of capital (WACC). The resulting present value represents the estimated intrinsic value of the company. DCF analysis allows investors to assess the attractiveness of an investment by comparing the intrinsic value with the current market price. If the intrinsic value is higher than the market price, the stock may be considered undervalued and potentially a good investment opportunity. Conversely, if the intrinsic value is lower than the market price, the stock may be overvalued, indicating a potential risk of future price decline. Comparable company analysis. Another commonly used valuation technique is the comparable company analysis, also known as a comps approach. This method involves comparing the financial ratios and valuation multiples of a target company with those of similar companies in the same industry or sector. To perform a comparable company analysis, analysts identify a group of comparable companies that have similar business models, size, growth prospects, and risk profiles. They then analyze the financial statements of these companies to calculate various valuation multiples, such as price-to-earnings (PE) ratio, price-to-sales (PS) ratio, or enterprise value to EBITDA EV/EBITDA ratio. By comparing the valuation multiples of the target company with those of its peers, analysts can assess whether the target company is overvalued or undervalued relative to its industry. If the target company's valuation multiples are lower than those of its peers, it may indicate that the stock is undervalued. Conversely, if the target company's valuation multiples are higher, it may suggest that the stock is overvalued. Comparable company analysis provides a relative valuation perspective, allowing investors to understand how the target company's valuation compares to its industry peers. However, it is important to consider other factors such as growth prospects, competitive advantages, and market conditions when interpreting the results of this analysis. Price-to-earnings (PE) ratio. The price-to-earnings (PE) ratio is a widely used valuation metric that compares a company's stock price to its earnings per share (EPS). It is calculated by dividing the market price per share by the EPS. The PE ratio provides insights into how much investors are willing to pay for each dollar of earnings generated by the company. A high PE ratio suggests that investors have high expectations for future earnings growth, while a low PE ratio may indicate that the stock is undervalued or that investors have lower expectations for future earnings. However, it is important to note that the PE ratio should not be used in isolation to make investment decisions. It should be compared to the PE ratios of other companies in the same industry or sector to assess relative valuation. Additionally, investors should consider other factors such as the company's growth prospects, competitive position, and industry dynamics. Dividend Discount Model (DDM). The dividend discount model (DDM) is a valuation technique commonly used for analyzing dividend-paying stocks. This model estimates the intrinsic value of a stock by discounting the expected future dividends back to their present value. To apply the DDM, analysts forecast the future dividends that a company is expected to pay based on its historical dividend payments, earnings growth, and dividend payout ratio. These projected dividends are then discounted using an appropriate discount rate, such as the company's cost of equity or the required rate of return. The DDM assumes that the value of a stock is equal to the present value of its future dividends. It is particularly useful for investors who prioritize income generation through dividends. However, it may not be suitable for companies that do not pay dividends or have an inconsistent dividend payment history. Other valuation techniques. In addition to the aforementioned valuation techniques, there are several other methods used by investors and analysts, including the price-to-book PB ratio, the enterprise value-to-sales EV sales ratio, and the residual income model RIM. Each of these techniques has its own strengths and limitations, and their applicability depends on the specific characteristics of the company and the investment objectives of the investor. It is important to note that valuation techniques are not foolproof and should be used in conjunction with other fundamental analysis tools. Market dynamics, investor sentiment, and macroeconomic factors can also influence stock prices. Therefore, investors should consider a holistic approach to investment analysis, combining valuation techniques with qualitative factors and market insights to make well-informed investment decisions. 10.3 Evaluating management performance. One of the key aspects of investment analysis is evaluating the performance of a company's management. The management team plays a crucial role in the success or failure of a business, and their decisions can have a significant impact on the financial performance of the company. As an investor, it is important to assess the competence and effectiveness of the management team before making any investment decisions. Importance of evaluating management performance. Evaluating management performance is essential because it provides insights into the ability of the management team to make sound strategic decisions, allocate resources effectively, and drive the company towards its goals. A strong and capable management team can navigate through challenges, adapt to changing market conditions, and create long-term value for shareholders. By analyzing management performance, investors can gain confidence in the company's ability to generate sustainable profits, manage risks, and create shareholder value. It helps investors identify companies with strong leadership and a track record of making prudent decisions, which can be an indication of future success. Key metrics for evaluating management performance. When evaluating management performance, there are several key metrics and indicators that investors can consider. These metrics provide insights into the effectiveness of the management team in various areas of the business. Here are some important metrics to consider. 1. Return on equity (ROE). Return on equity measures the profitability of a company in relation to the shareholders' equity. It indicates how effectively the management team is utilizing the company's resources to generate profits. A consistently high ROE suggests that the management team is efficient in generating returns for shareholders. 2. Earnings per share (EPS) growth. EPS growth measures the rate at which a company's earnings per share are increasing over time. It reflects the management team's ability to grow profits and create value for shareholders. Consistent and sustainable EPS growth is a positive sign of effective management. 3. Operating margin. Operating margin measures the profitability of a company's core operations. It indicates how well the management team is controlling costs and generating profits from its primary business activities. A higher operating margin suggests sufficient management of resources and effective cost control. 4. Cash flow management. Cash flow management is crucial for the financial health of a company. It reflects the management team's ability to generate and effectively utilize cash. Positive cash flow indicates that the management team is effectively managing the company's working capital, investments, and financing activities. 5. Return on investment (ROI). Return on investment measures the efficiency of the management team in generating returns from the company's investments. It assesses the effectiveness of capital allocation decisions made by the management team. A higher ROI suggests that the management team is making wise investment decisions. Qualitative factors for evaluating management performance. In addition to quantitative metrics, there are also qualitative factors that investors can consider when evaluating management performance. These factors provide insights into the leadership qualities, strategic vision, and decision-making abilities of the management team. Here are some important qualitative factors to consider. 1. Leadership and experience. Assessing the leadership qualities and experience of the management team is crucial. Look for a management team with a proven track record of success, industry expertise, and the ability to inspire and motivate employees. 2. Strategic vision. Evaluate the management team's strategic vision for the company. Look for a clear and well-defined strategy that aligns with the company's long-term goals. A strong strategic vision indicates that the management team has a clear direction for the company's growth and success. 3. Communication and transparency. Consider the management team's communication style and transparency with shareholders. Look for a management team that provides regular and clear updates on the company's performance, challenges, and future plans. Open and transparent communication is a sign of good governance and accountability. 4. Risk management. Assess the management team's ability to identify and manage risks effectively. Look for a proactive approach to risk management and a clear understanding of the potential risks and challenges facing the company. A strong risk management framework indicates that the management team is focused on protecting shareholder value. Assessing management performance through annual reports. Annual reports are a valuable source of information for evaluating management performance. They provide detailed insights into the company's financial performance, strategic initiatives, and management's discussion and analysis of the business. Here are some key sections of the annual report to focus on when assessing management performance. 1. Management's discussion and analysis (MD&A). The MD&A section provides a narrative explanation of the company's financial performance, key initiatives, and future prospects. It offers insights into the management team's strategic thinking, challenges faced, and plans for the future. Pay attention to the management's assessment of the company's performance and their plans for growth. 2. Corporate governance. The corporate governance section provides information about the company's board of directors, executive compensation, and governance practices. Assess the independence and expertise of the board members and the alignment of executive compensation with shareholder interests. Look for a strong governance framework that promotes accountability and transparency. 3. Financial statements and footnotes. Review the financial statements and footnotes to gain insights into the company's financial performance, accounting policies, and potential risks. Analyze the trends in key financial metrics and assess the management team's ability to generate consistent and sustainable profits. 4. Auditor's report. Pay attention to the auditor's report, which provides an independent assessment of the company's financial statements. Look for any qualifications or concerns raised by the auditor, as it may indicate potential issues with the management team's financial reporting practices. Conclusion. Evaluating management performance is a critical aspect of investment analysis. By assessing both quantitative metrics and qualitative factors, investors can gain insights into the competence, effectiveness, and integrity of the management team. Annual reports provide valuable information for evaluating management performance, and investors should carefully analyze the sections that provide insights into the company's financial performance, strategic initiatives, and governance practices. By considering management performance alongside other financial and non-financial factors, investors can make more informed investment decisions. 10.4 Risk Assessment. When it comes to using financial statements for investment analysis, one crucial aspect that cannot be overlooked is risk assessment. Risk assessment involves evaluating the potential risks associated with an investment and determining the likelihood of those risks materializing. By understanding the risks involved, investors can make more informed decisions and manage their investment portfolios effectively. Importance of risk assessment. Risk assessment plays a vital role in investment analysis as it helps investors identify and evaluate the potential risks that could impact their investment returns. By assessing risks, investors can make informed decisions about whether to invest in a particular company or asset. It allows them to understand the potential downside and the likelihood of negative events occurring. Without proper risk assessment, investors may be exposed to unforeseen risks that could lead to significant financial losses. By conducting a thorough risk assessment, investors can mitigate potential risks and make more informed investment decisions. Types of risks. There are various types of risks that investors need to consider when assessing an investment opportunity. Some of the common risks include market risk. Market risk refers to the potential losses that can occur due to changes in market conditions, such as fluctuations in interest rates, exchange rates, or stock market prices. Market risk is inherent in all investments and cannot be eliminated entirely. Credit risk. Credit risk is the risk of default by the issuer of a debt instrument, such as a bond or a loan. It refers to the possibility that the borrower may not be able to repay the principal or interest as per the agreed terms. Credit risk is particularly relevant when investing in corporate bonds or lending to individuals or companies. Liquidity risk. Liquidity risk refers to the risk of not being able to buy or sell an investment quickly enough at a fair price. Illiquid investments can be challenging to sell, especially during times of market stress, and may result in losses or missed opportunities. Operational risk. Operational risk arises from the potential failures or weaknesses in an organization's internal processes, systems, or people. It includes risks related to fraud, errors, technology failures, and legal or regulatory compliance. Operational risk can have a significant impact on a company's financial performance and stability. Political and regulatory risk. Political and regulatory risks arise from changes in government policies, regulations, or geopolitical events that can impact the investment environment. These risks can affect specific industries or companies operating in certain regions or countries. Reputation risk. Reputation risk refers to the potential damage to a company's reputation due to negative public perception, scandals, or unethical behavior. A tarnished reputation can lead to a loss of customers, business opportunities, and ultimately, financial losses. Risk assessment techniques. To assess and manage risks effectively, investors use various techniques and tools. Some of the commonly used risk assessment techniques include qualitative analysis. Qualitative analysis involves evaluating risks based on subjective factors, such as management quality, industry dynamics, competitive landscape, and regulatory environment. It relies on expert judgment and industry knowledge to assess the potential impact of risks. Quantitative analysis. Quantitative analysis involves using statistical models and historical data to assess risks. It includes techniques such as value at risk, VAR, stress testing, and scenario analysis. Quantitative analysis provides a more objective and data-driven approach to risk assessment. Risk rating systems. Risk rating systems assign a numerical score or rating to different risks based on their severity and likelihood of occurrence. These systems help investors prioritize risks and allocate resources accordingly. Rating agencies often use risk rating systems to assess the creditworthiness of companies and debt instruments. Sensitivity analysis. Sensitivity analysis involves assessing how changes in specific variables or assumptions can impact investment returns. By analyzing different scenarios, investors can understand the sensitivity of their investments to various risk factors. Diversification. Diversification is a risk management strategy that involves spreading investments across different asset classes, sectors, or geographic regions. By diversifying their portfolios, investors can reduce the impact of individual risks and potentially enhance overall returns. Incorporating risk assessment into investment decisions. To incorporate risk assessment into investment decisions, investors should follow a systematic approach. Identify risks. Start by identifying the potential risks associated with the investment. Consider both general market risks and specific risks related to the company or asset. Evaluate risks. Assess the severity and likelihood of each identified risk. Consider the potential impact on investment returns and the probability of occurrence. Quantify risks. Use quantitative techniques, such as sensitivity analysis or risk rating systems, to quantify the risks. Assign numerical values or ratings to each risk based on their severity and likelihood. Mitigate risks. Develop risk mitigation strategies to minimize the impact of identified risks. This may involve diversification, hedging, or setting risk limits. Monitor risks. Continuously monitor the investment portfolio and the external environment for changes in risk factors. Regularly review and update risk assessments to ensure they remain relevant. By incorporating risk assessment into their investment decisions, investors can make more informed choices and manage their portfolios effectively. It allows them to strike a balance between potential returns and the risks they are willing to take, ultimately leading to better investment outcomes. In conclusion, risk assessment is a critical component of using financial statements for investment analysis. By identifying, evaluating, and managing risks, investors can make informed decisions and protect their investment portfolios from potential losses. Understanding the various types of risks and employing appropriate risk assessment techniques is essential for successful investment management. 11. Financial statements for decision making. 11.1 Financial statements and business strategy. Financial statements are not just a collection of numbers and figures, they provide valuable insights into a company's financial health and performance. These statements are essential tools for decision making, and they play a crucial role in shaping a company's business strategy. The role of financial statements in business strategy. Financial statements provide a comprehensive overview of a company's financial position, performance, and cash flows. They help management and stakeholders understand the company's current financial status and make informed decisions about its future direction. Assessing financial performance. One of the primary uses of financial statements in business strategy is to assess the company's financial performance. By analyzing the income statement, balance sheet, and cash flow statement, management can evaluate the company's profitability, liquidity, and solvency. This assessment helps identify areas of strength and weakness, enabling management to make strategic decisions to improve financial performance. For example, if a company's income statement shows declining profitability, management may decide to implement cost-cutting measures or explore new revenue streams. Similarly, if a balance sheet reveals a high level of debt, management may focus on debt reduction strategies to improve the company's solvency. Identifying growth opportunities. Financial statements also play a crucial role in identifying growth opportunities for a company. By analyzing revenue trends, expense patterns, and cash flow patterns, management can identify areas of potential growth or expansion. For instance, if the income statement shows a consistent increase in revenue from a particular product or market segment, management may decide to allocate more resources to capitalize on that growth opportunity. Similarly, if the cash flow statement indicates a positive cash flow from operating activities, management may consider investing in research and development or acquiring new assets to fuel further growth. Evaluating investment decisions. Financial statements are vital in evaluating investment decisions. When considering potential investments, management can use financial statements to assess the financial viability and potential returns of the investment. By analyzing the financial statements of a target company, management can evaluate its financial health, profitability, and growth prospects. This analysis helps determine whether the investment aligns with the company's overall business strategy and financial goals. Strategic planning and forecasting. Financial statements also play a crucial role in strategic planning and forecasting. By analyzing historical financial data, management can identify trends and patterns that can inform future strategic decisions. For example, if the income statement shows a decline in revenue from a particular product line, management may decide to discontinue or revamp that product line. Similarly, if the balance sheet indicates a significant increase in cash reserves, management may consider using those funds for strategic acquisitions or expansion. Financial statements also provide the foundation for financial forecasting. By projecting future financial performance based on historical data and market trends, management can develop realistic financial goals and create a roadmap for achieving them. Integrating financial statements into business strategy. To effectively integrate financial statements into business strategy, companies need to establish a robust financial reporting and analysis framework. This framework should include timely and accurate financial reporting. Timely and accurate financial reporting is crucial for effective decision-making. Companies should ensure that their financial statements are prepared in accordance with accounting standards and regulations and are released in a timely manner. This allows management to have up-to-date information for strategic decision-making. Regular financial analysis. Regular financial analysis is essential for understanding the implications of the financial statements and identifying areas for improvement. Companies should conduct regular financial analysis to assess their financial performance, identify trends, and make informed decisions about their business strategy. Cross-functional collaboration. Integrating financial statements into business strategy requires cross-functional collaboration. Finance teams should work closely with other departments, such as marketing, operations, and sales, to align financial goals with overall business objectives. This collaboration ensures that financial decisions are made in the context of the company's broader strategy. Scenario planning and sensitivity analysis. To make informed strategic decisions, companies should conduct scenario planning and sensitivity analysis based on their financial statements. By simulating different scenarios and assessing their impact on financial performance, management can evaluate the potential risks and rewards of different strategic options. Conclusion. Financial statements are powerful tools that provide valuable insights into a company's financial health and performance. By integrating financial statements into business strategy, companies can make informed decisions, identify growth opportunities, evaluate investments, and plan for the future. Timely and accurate financial reporting, regular financial analysis, cross-functional collaboration, and scenario planning are essential components of effectively using financial statements to shape business strategy. 11.2 Capital budgeting decisions. Capital budgeting decisions are crucial for businesses as they involve determining which investment projects to undertake and how to allocate financial resources. These decisions have a significant impact on a company's long-term profitability and growth. To make informed capital budgeting decisions, businesses rely on various financial statements, including the balance sheet, income statement, and cash flow statement. The role of financial statements in capital budgeting. Financial statements provide valuable information that helps businesses evaluate the feasibility and potential profitability of investment projects. When considering capital budgeting decisions, companies typically analyze the following financial statement components. 1. Balance sheet. The balance sheet provides a snapshot of a company's financial position at a specific point in time. It presents the company's assets, liabilities, and equity. When assessing capital budgeting decisions, businesses focus on the asset side of the balance sheet to determine the availability of funds for investment. They also consider the company's liabilities and equity to understand the financial stability and leverage. 2. Income statement. The income statement shows a company's revenues, expenses, and net income over a specific period. It helps businesses assess the profitability of investment projects by analyzing the potential impact on revenues and expenses. By understanding the income statement, companies can estimate the future cash flows generated by an investment and evaluate its profitability. 3. Cash flow statement. The cash flow statement provides insights into a company's cash inflows and outflows during a specific period. It categorizes cash flows into operating, investing, and financing activities. When making capital budgeting decisions, businesses focus on the cash flow statement to evaluate the cash flows associated with an investment project. They assess the project's ability to generate positive cash flows and ensure sufficient liquidity for future operations. Techniques for capital budgeting decisions. To evaluate investment projects effectively, businesses employ various techniques that utilize information from financial statements. Some commonly used techniques for capital budgeting decisions include 1. Net present value (NPV). Net present value calculates the present value of expected cash inflows and outflows associated with an investment project. By discounting future cash flows to their present value, businesses can determine the project's profitability. If the NPV is positive, the project is considered financially viable. 2. Internal rate of return (IRR). The internal rate of return is the discount rate that makes the NPV of an investment project equal to 0. It represents the project's expected rate of return. Businesses compare the IRR with their required rate of return to assess the project's attractiveness. If the IRR exceeds the required rate of return, the project is considered acceptable. 3. Payback period. The payback period measures the time required to recover the initial investment in an investment project. It helps businesses assess the project's risk and liquidity. Projects with shorter payback periods are generally preferred as they offer quicker returns on investment. 4. Profitability index. The profitability index compares the present value of expected cash inflows to the initial investment. It helps businesses evaluate the profitability of an investment project relative to its cost. A profitability index greater than 1 indicates a financially viable project. Considerations for capital budgeting decisions. When making capital budgeting decisions, businesses should consider several factors beyond financial statements. These factors include 1. Risk assessment. Businesses need to assess the risks associated with an investment project. They should consider factors such as market conditions, competition, technological advancements, and regulatory changes. By evaluating the potential risks, businesses can make informed decisions and mitigate potential losses. 2. Strategic alignment. Investment projects should align with a company's overall strategic objectives and long-term goals. Businesses should evaluate how an investment project fits into their existing operations and whether it contributes to their competitive advantage. 3. Projected cash flows. Accurate estimation of projected cash flows is crucial for capital budgeting decisions. Businesses should consider factors such as sales forecasts, cost projections, and potential changes in market conditions. By conducting thorough analysis, businesses can make more reliable projections and minimize the risk of financial losses. 4. Sensitivity analysis. Sensitivity analysis involves assessing the impact of changes in key variables on the project's financial viability. By analyzing different scenarios and considering potential fluctuations in variables such as sales volume, costs, and interest rates, businesses can evaluate the project's sensitivity to changes in the business environment. Conclusion. Capital budgeting decisions play a vital role in a company's long-term success. By utilizing information from financial statements and employing various evaluation techniques, businesses can make informed decisions about investment projects. However, it is essential to consider factors beyond financial statements, such as risk assessment, strategic alignment, projected cash flows, and sensitivity analysis. By carefully evaluating these factors, businesses can enhance their capital budgeting decisions and maximize their profitability and growth potential. 11.3 Investment analysis. Investment analysis is a crucial aspect of financial decision-making. It involves evaluating the financial statements of a company to determine its investment potential. By carefully analyzing the information presented in the financial statements, investors can make informed decisions about whether to invest in a particular company or not. Importance of investment analysis. Investment analysis plays a vital role in the investment process as it helps investors assess the financial health and performance of a company. By examining the financial statements, investors can gain insights into the company's profitability, liquidity, solvency, and overall financial stability. This analysis provides a foundation for making investment decisions based on objective data rather than relying solely on intuition or market trends. Key components of investment analysis. When conducting investment analysis, there are several key components that investors should consider. 1. Financial ratios. Financial ratios are essential tools for investment analysis. They provide a quantitative measure of a company's financial performance and help investors compare different companies within the same industry. Ratios such as return on investment (ROI), earnings per share (EPS), and price to earnings (PE) ratio can provide valuable insights into a company's profitability, efficiency, and market valuation. 2. Industry analysis. Investors should also consider the industry in which the company operates. Understanding the industry dynamics, competitive landscape, and market trends can help investors assess a company's growth potential and competitive advantage. Industry analysis provides context for evaluating a company's financial statements and helps investors make more informed investment decisions. 3. Management evaluation. Assessing the quality and competence of a company's management team is crucial for investment analysis. Investors should evaluate the track record of the management team, their strategic vision, and their ability to execute the company's business plan. A strong and capable management team is more likely to drive the company's success and generate value for shareholders. 4. Risk assessment. Investors should carefully evaluate the risks associated with investing in a particular company. This includes analyzing both internal and external risks that could impact the company's financial performance. Internal risks may include operational inefficiencies, high debt levels, or poor corporate governance. External risks may include changes in market conditions, regulatory changes, or economic downturns. By assessing the risks, investors can make more informed decisions and manage their investment portfolios effectively. Tools and techniques for investment analysis. To conduct investment analysis effectively, investors can utilize various tools and techniques. Some commonly used methods include: 1. Fundamental analysis. Fundamental analysis involves examining a company's financial statements, industry position, and economic factors to determine its intrinsic value. This approach focuses on understanding the company's financial health, competitive advantage, and growth prospects. By analyzing key financial ratios, conducting industry research, and evaluating management, investors can estimate the fair value of a company's stock and make investment decisions accordingly. 2. Valuation techniques. Valuation techniques help investors determine the worth of a company's stock or investment opportunity. Common valuation methods include discounted cash flow (DCF) analysis, price to earnings (PE) ratio, price to sales (PS) ratio, and price to book (PB) ratio. These techniques provide a quantitative assessment of a company's value relative to its financial performance and market position. 3. Evaluating management performance. Investors should evaluate the performance of a company's management team to assess their ability to create shareholder value. This includes analyzing their strategic decisions, capital allocation practices, and overall corporate governance. By understanding the management's track record and their alignment with shareholder interests, investors can gain confidence in their investment decisions. 4. Risk assessment models. Risk assessment models help investors quantify and manage the risks associated with their investment decisions. These models use historical data, statistical analysis, and probability theory to estimate the likelihood of various risks and their potential impact on investment returns. By incorporating risk assessment into their investment analysis, investors can make more informed decisions and build diversified portfolios. Conclusion. Investment analysis is a critical process for investors seeking to make informed decisions about where to allocate their capital. By carefully analyzing the financial statements, conducting industry research, evaluating management performance, and assessing risks, investors can gain valuable insights into a company's investment potential. Utilizing tools and techniques such as financial ratios, valuation methods, and risk assessment models further enhances the investment analysis process. Ultimately, investment analysis helps investors make informed decisions that align with their investment goals and risk tolerance. 11.4 Financial Statement Forecasting. Financial statement forecasting is a crucial aspect of financial analysis and decision-making. By projecting future financial performance based on historical data and market trends, businesses can gain valuable insights into their future prospects and make informed strategic decisions. In this section, we will explore the importance of financial statement forecasting, the methods used for forecasting, and the key considerations to keep in mind when conducting these projections. Importance of financial statement forecasting. Financial statement forecasting plays a vital role in strategic planning, budgeting, and investment decision-making. It allows businesses to anticipate future financial outcomes, identify potential risks and opportunities, and align their resources accordingly. Here are some key reasons why financial statement forecasting is important. Strategic planning. Forecasting helps businesses set realistic goals and objectives by providing a clear picture of their financial future. It enables management to develop effective strategies and allocate resources efficiently to achieve desired outcomes. Budgeting and resource allocation. By forecasting financial statements, businesses can estimate their future revenue, expenses, and cash flows. This information is crucial for creating accurate budgets and making informed decisions regarding resource allocation. Investment decision-making. Investors and stakeholders rely on financial statement forecasts to assess the potential return on investment and make informed decisions about capital allocation. Accurate forecasts provide valuable insights into a company's financial health and growth prospects. Risk management. Financial statement forecasting helps identify potential risks and uncertainties that may impact a company's financial performance. By understanding these risks in advance, businesses can develop contingency plans and take proactive measures to mitigate them. Methods of financial statement forecasting. There are several methods and techniques used for financial statement forecasting. The choice of method depends on the availability of data, the complexity of the business, and the specific requirements of the analysis. Here are some commonly used methods. Historical analysis. This method involves analyzing past financial data to identify trends and patterns that can be used to project future performance. By examining historical growth rates, revenue patterns, and expense trends, businesses can make reasonable assumptions about future financial outcomes. Time series analysis. Time series analysis involves using statistical techniques to analyze historical data and identify patterns, seasonality, and trends. This method is particularly useful when forecasting variables such as sales, revenue, or market demand. Regression analysis. Regression analysis is a statistical technique that helps identify the relationship between dependent and independent variables. By analyzing historical data, businesses can use regression models to forecast future financial performance based on the relationship between different variables. Qualitative methods. Qualitative methods involve using expert judgment, market research, and industry analysis to forecast financial statements. These methods are particularly useful when there is limited historical data or when external factors such as market conditions or regulatory changes significantly impact the business. Key considerations for financial statement forecasting. When conducting financial statement forecasting, it is essential to consider certain factors to ensure the accuracy and reliability of the projections. Here are some key considerations to keep in mind. Data quality and availability. The accuracy and reliability of financial statement forecasts depend on the quality and availability of historical data. It is crucial to ensure that the data used for forecasting is accurate, complete, and representative of the business's operations. Assumptions and sensitivity analysis. Financial statement forecasts are based on certain assumptions about future market conditions, business performance, and other factors. It is important to clearly document these assumptions and conduct sensitivity analysis to understand the potential impact of changes in these assumptions on the forecasted outcomes. Market and industry analysis. External factors such as market trends, industry dynamics, and regulatory changes can significantly impact a company's financial performance. It is important to conduct a thorough analysis of the market and industry to incorporate these factors into the forecasting process. Scenario analysis. Financial statement forecasting should consider different scenarios and potential outcomes. By analyzing best case, worst case, and most likely scenarios, businesses can assess the range of possible outcomes and develop contingency plans accordingly. Regular monitoring and updating. Financial statement forecasts should be regularly monitored and updated to reflect changes in market conditions, business performance, and other relevant factors. By reviewing and updating forecasts, businesses can ensure that their strategic decisions are based on the most up-to-date information. Financial statement forecasting is a valuable tool for businesses to plan, make informed decisions, and assess their future financial performance. By using appropriate forecasting methods, considering key factors, and regularly updating the forecasts, businesses can gain valuable insights into their financial future and navigate the dynamic business environment with confidence. 12. Financial statements for stakeholders. 12.1 Financial statements for shareholders. As a shareholder, understanding and analyzing financial statements is crucial for making informed investment decisions. Financial statements provide valuable information about a company's financial performance, position, and prospects. By reading and interpreting these statements, shareholders can assess the company's profitability, liquidity, solvency, and overall financial health. Importance of financial statements for shareholders. Financial statements serve as a primary source of information for shareholders to evaluate the performance and value of their investments. These statements provide a comprehensive overview of a company's financial activities, including its revenues, expenses, assets, liabilities, and equity. By analyzing these figures, shareholders can assess the company's ability to generate profits, manage its debts, and create value for its shareholders. Financial statements also help shareholders understand the company's financial position and its potential risks and opportunities. By examining the balance sheet, shareholders can assess the company's assets, liabilities, and equity, which provide insights into its financial stability and ability to meet its obligations. The income statement reveals the company's revenue sources, expenses, and profitability, allowing shareholders to evaluate its operational efficiency and profitability. The cash flow statement provides information about the company's cash inflows and outflows, helping shareholders assess its liquidity and cash management practices. Interpreting financial statements. To effectively interpret financial statements, shareholders need to understand the key components and ratios used in financial analysis. Here are some important aspects to consider. Revenue and profitability. Shareholders should analyze the company's revenue growth over time and compare it to industry peers. Additionally, assessing the company's gross profit margin, operating profit margin, and net profit margin helps determine its profitability and efficiency. Liquidity and solvency. Shareholders should examine liquidity ratios such as the current ratio and quick ratio to assess the company's ability to meet short-term obligations. Solvency ratios like the debt-to-equity ratio and interest coverage ratio provide insights into the company's long-term financial stability and ability to repay debts. Return on investment. Shareholders should evaluate the company's return on equity (ROE) and return on assets (ROA) to assess its ability to generate profits from shareholders' investments and efficiently utilize its assets. Cash flow. Analyzing the cash flow statement helps shareholders understand the company's cash generation, operating cash flow, investing activities, and financing activities. Positive cash flow indicates a healthy financial position and the ability to fund operations and investments. Notes to the financial statements. Shareholders should carefully review the notes to the financial statements, which provide additional information about accounting policies, significant events, contingent liabilities, and other relevant details that may impact the company's financial position. Using financial statements for decision-making. Financial statements play a vital role in shareholders' decision-making processes. By analyzing these statements, shareholders can make informed decisions regarding buying, holding, or selling their shares. Here are some ways shareholders can use financial statements for decision-making. Investment decisions. Shareholders can assess the company's financial performance and prospects to determine whether to invest in or divest from the company. By comparing financial ratios and trends, shareholders can identify companies with strong growth potential and sound financial health. Voting and proxy decisions. Shareholders can use financial statements to evaluate the company's management performance and financial policies. This information helps shareholders make informed decisions when voting on important matters, such as electing directors or approving mergers and acquisitions. Dividend decisions. Shareholders can analyze the company's profitability, cash flow, and dividend history to assess the likelihood of receiving dividends. Financial statements provide insights into the company's ability to generate profits and distribute them to shareholders. Risk assessment. Financial statements help shareholders assess a company's financial risks, such as excessive debt, declining profitability, or liquidity issues. By understanding these risks, shareholders can make informed decisions about the level of risk they are willing to tolerate. Limitations of financial statements. While financial statements provide valuable information, shareholders should be aware of their limitations. Financial statements are historical in nature and may not reflect the current or future performance of a company. Additionally, financial statements rely on accounting principles and estimates, which can vary between companies and impact comparability. Shareholders should consider other factors, such as industry trends, competitive landscape, and macroeconomic conditions, in conjunction with financial statements to make well-rounded investment decisions. In conclusion, financial statements are essential tools for shareholders to assess a company's financial performance, position, and prospects. By understanding and interpreting these statements, shareholders can make informed investment decisions, evaluate management performance, and assess the overall financial health of the company. However, it is important to consider the limitations of financial statements and supplement them with other relevant information to gain a comprehensive understanding of the company's financial situation. 12.2 Financial Statements for Creditors. Creditors play a crucial role in the financial ecosystem of a company. They are individuals or institutions that lend money or extend credit to a company, expecting repayment with interest within a specified period. As a creditor, it is essential to assess the financial health and stability of a company before extending credit. One of the primary tools for evaluating a company's financial position is through the analysis of its financial statements. Importance of financial statements for creditors. Financial statements provide creditors with valuable information about a company's financial position, performance, and cash flow. These statements are prepared and presented by the company's management and are audited by independent external auditors to ensure their accuracy and reliability. Creditors rely on these statements to make informed decisions about lending money or extending credit to a company. By analyzing financial statements, creditors can assess the creditworthiness and repayment capacity of a company. They can evaluate the company's ability to generate sufficient cash flow to meet its financial obligations, including interest payments and principal repayments. Financial statements also provide insights into a company's liquidity, profitability, and leverage, which are crucial factors in determining credit risk. Key financial statements for creditors. Creditors primarily focus on three key financial statements: the balance sheet, the income statement, and the cash flow statement. Each statement provides unique information that helps creditors assess the financial health of a company. Balance sheet. The balance sheet provides a snapshot of a company's financial position at a specific point in time. It presents the company's assets, liabilities, and shareholders' equity. Creditors analyze the balance sheet to understand the company's liquidity and solvency. They assess the composition and quality of the company's assets and evaluate its ability to meet its short-term and long-term obligations. Creditors pay particular attention to the company's current assets, such as cash, accounts receivable, and inventory, as these assets can be used to repay short-term debts. They also analyze the company's long-term assets, such as property, plant, and equipment, to assess its ability to generate future cash flows. On the liabilities side, creditors evaluate the company's current and long-term liabilities to determine its debt levels and repayment obligations. They assess the company's ability to generate sufficient cash flow to service its debt and evaluate the quality of its collateral, if any. Income statement. The income statement, also known as the profit and loss statement, provides information about a company's revenues, expenses, and net income over a specific period. Creditors analyze the income statement to assess the company's profitability and its ability to generate consistent earnings. Creditors focus on the company's revenue sources, the stability of its revenue streams, and the trends in its operating expenses. They evaluate the company's gross profit margin and operating profit margin to understand its ability to cover its operating expenses and generate profits. Net income is of particular interest to creditors as it represents the company's bottom line after all expenses, including interest and taxes, have been deducted. Creditors assess the company's net income to evaluate its ability to generate sufficient cash flow to service its debt and meet its financial obligations. Cash flow statement. The cash flow statement provides insights into a company's cash inflows and outflows over a specific period. Creditors analyze the cash flow statement to assess the company's ability to generate cash from its operating activities, investing activities, and financing activities. Creditors pay close attention to the company's operating cash flow, as it represents the cash generated from its core business operations. They evaluate the company's ability to generate consistent and positive operating cash flow to ensure it can meet its day-to-day expenses and service its debt. Creditors also analyze the company's investing and financing activities to understand its capital expenditure plans, debt repayments, and capital raising activities. They assess the company's ability to generate cash from its investments and evaluate its reliance on external financing. Financial ratios for creditors. In addition to analyzing the financial statements, creditors often use financial ratios to gain further insights into a company's financial health. Financial ratios provide a standardized way to compare and evaluate a company's performance and financial position. Creditors commonly use liquidity ratios, such as the current ratio and the quick ratio, to assess a company's ability to meet its short-term obligations. These ratios measure the company's ability to convert its current assets into cash to cover its current liabilities. Creditors also analyze profitability ratios, such as the return on assets and the return on equity, to evaluate the company's ability to generate profits from its assets and equity. These ratios help creditors assess the company's profitability and its ability to generate sufficient cash flow to service its debt. Furthermore, creditors consider leverage ratios, such as the debt-to-equity ratio and the interest coverage ratio, to evaluate the company's leverage and its ability to meet its debt obligations. These ratios provide insights into the company's capital structure and its ability to cover interest payments. Conclusion. Financial statements are invaluable tools for creditors when assessing the creditworthiness and financial stability of a company. By analyzing the balance sheet, income statement, and cash flow statement, creditors can evaluate a company's liquidity, profitability, and cash flow generation. Financial ratios further enhance the analysis by providing standardized benchmarks for comparison. Armed with this information, creditors can make informed decisions about lending money or extending credit to a company, mitigating their credit risk and ensuring the safety of their investments. 12.3 Financial Statements for Employees. As an employee, understanding and interpreting financial statements can provide valuable insights into the financial health and stability of the company you work for. Financial statements are not only important for shareholders and creditors but also for employees who want to assess the company's performance, profitability, and overall financial well-being. By analyzing these statements, employees can gain a better understanding of the company's financial position and make informed decisions about their career and financial future. Importance of financial statements for employees. Financial statements provide employees with a comprehensive view of the company's financial performance, including its revenue, expenses, assets, liabilities, and equity. By examining these statements, employees can assess the company's profitability, stability, and growth potential. This information is crucial for employees to make informed decisions about their job security, career growth opportunities, and overall financial well-being. Understanding the income statement. The income statement, also known as the profit and loss statement, provides employees with insights into the company's revenue, expenses, and net income. By analyzing the income statement, employees can understand the company's financial performance over a specific period. They can assess whether the company is generating sufficient revenue to cover its expenses and generate profits. This information can help employees gauge the company's financial stability and growth potential, which can impact their job security and career prospects. Analyzing the balance sheet. The balance sheet provides employees with a snapshot of the company's financial position at a specific point in time. It outlines the company's assets, liabilities, and equity. By examining the balance sheet, employees can assess the company's liquidity, solvency, and overall financial health. They can determine whether the company has sufficient assets to cover its liabilities and evaluate its ability to meet its financial obligations. This information is crucial for employees to understand the company's financial stability and assess the potential risks associated with their employment. Interpreting the cash flow statement. The cash flow statement provides employees with insights into the company's cash inflows and outflows from its operating, investing, and financing activities. By analyzing the cash flow statement, employees can understand how the company generates and uses its cash. They can assess the company's ability to generate cash from its core operations, invest in growth opportunities, and meet its financial obligations. This information is essential for employees to evaluate the company's financial strength and its ability to sustain its operations and provide job security. Assessing financial ratios. Financial ratios provide employees with a quantitative analysis of the company's financial performance and position. By calculating and analyzing various financial ratios, employees can gain insights into the company's liquidity, profitability, efficiency, and leverage. These ratios can help employees assess the company's ability to generate profits, manage its debts, and utilize its assets effectively. Understanding financial ratios can provide employees with a deeper understanding of the company's financial health and stability, which can impact their career decisions and financial planning. Evaluating notes to the financial statements. The notes to the financial statements provide additional information and explanations about the company's financial statements. Employees can find important details about accounting policies, significant events, contingent liabilities, and other relevant information in the notes. By carefully reviewing the notes, employees can gain a better understanding of the company's financial statements and the underlying assumptions and estimates used in their preparation. This information can help employees assess the reliability and accuracy of the financial statements and make informed decisions about their employment and financial future. Using financial statements for career planning. Financial statements can be valuable tools for employees to plan their careers and make informed decisions about their professional development. By analyzing the company's financial performance, stability, and growth potential, employees can assess the opportunities for career advancement within the organization. They can identify departments or divisions that are performing well and have growth potential, which can guide their career choices. Additionally, understanding the company's financial health can help employees assess the risks associated with their employment and make informed decisions about job security and long-term career prospects. Conclusion. Financial statements are not only important for shareholders and creditors but also for employees. By understanding and analyzing financial statements, employees can gain valuable insights into the company's financial performance, stability, and growth potential. This information can help employees make informed decisions about their career, job security, and overall financial well-being. By utilizing financial statements as a tool for analysis and decision-making, employees can navigate their professional lives with greater confidence and clarity. 12.4 Financial Statements for Government and Regulators. Government entities and regulatory bodies play a crucial role in overseeing the financial activities of businesses and ensuring compliance with laws and regulations. As part of their oversight responsibilities, they rely on financial statements to assess the financial health and performance of companies. Financial statements provide valuable information that helps government agencies and regulators make informed decisions, monitor compliance, and protect the interests of various stakeholders. Regulatory compliance. One of the primary reasons government entities and regulators rely on financial statements is to ensure regulatory compliance. Companies are required to adhere to specific accounting standards and regulations set by regulatory bodies such as the Securities and Exchange Commission (SEC) in the United States or the Financial Reporting Council (FRC) in the United Kingdom. These standards dictate how financial statements should be prepared, presented, and disclosed. Government agencies and regulators review financial statements to ensure that companies are following these standards and regulations. They assess whether the financial statements accurately represent the company's financial position, performance, and cash flows. By examining the financial statements, regulators can identify any potential violations or discrepancies that may require further investigation or enforcement actions. Assessing financial stability. Government entities and regulators are also concerned with the financial stability of companies operating within their jurisdiction. Financial statements provide valuable insights into a company's financial health, including its liquidity, solvency, and profitability. By analyzing these financial indicators, regulators can assess the overall stability of the company and its ability to meet its financial obligations. For example, government regulators may review a company's balance sheet to evaluate its liquidity position. They examine the company's current assets and liabilities to determine if it has sufficient working capital to cover its short-term obligations. This analysis helps regulators assess the company's ability to continue its operations and meet its financial commitments. Similarly, regulators may analyze a company's income statement to evaluate its profitability. They examine the company's revenue, expenses, and net income to assess its financial performance. This analysis helps regulators gauge the company's ability to generate profits and sustain its operations in the long run. Detecting fraud and misconduct. Financial statements can also serve as a valuable tool for government entities and regulators in detecting fraud, misconduct, or other irregularities. By carefully examining the financial statements, regulators can identify any red flags or suspicious activities that may indicate fraudulent practices. For instance, regulators may scrutinize a company's cash flow statement to identify any unusual or unexplained cash flows. Large and unexplained changes in cash balances or discrepancies between reported cash flows and actual cash movements can raise concerns and trigger further investigations. Regulators may also analyze the notes to the financial statements, which provide additional information and disclosures about the company's accounting policies and practices. By reviewing these notes, regulators can identify any inconsistencies or deviations from generally accepted accounting principles (GAAP) or International Financial Reporting Standards (IFRS). Monitoring industry compliance. In addition to assessing individual companies, government entities and regulators also rely on financial statements to monitor compliance within specific industries. They compare financial statements across companies within the same industry to identify trends, patterns, and potential risks. By analyzing financial statements at an industry level, regulators can identify any systemic issues or vulnerabilities that may require regulatory intervention. For example, if multiple companies within a particular industry consistently report losses or exhibit financial distress, regulators may investigate the underlying causes and take appropriate actions to mitigate risks and protect stakeholders. Disclosure and transparency. Financial statements also contribute to the overall transparency and accountability of companies. Government entities and regulators rely on the information disclosed in financial statements to ensure that companies provide accurate and reliable financial information to the public and stakeholders. Regulators may require companies to submit their financial statements on a regular basis, such as quarterly or annually, to ensure timely and consistent reporting. These statements are then made available to the public, allowing investors, analysts, and other stakeholders to assess the financial health and performance of companies. By promoting transparency and disclosure, financial statements help foster trust and confidence in the financial markets. They provide a standardized framework for reporting financial information, enabling stakeholders to make informed decisions and assess the risks associated with investing or doing business with a particular company. In conclusion, financial statements play a vital role in the oversight and regulation of businesses by government entities and regulatory bodies. These statements provide valuable information that helps regulators ensure compliance, assess financial stability, detect fraud, monitor industry trends, and promote transparency. By relying on financial statements, government entities and regulators can effectively fulfill their responsibilities in protecting the interests of various stakeholders and maintaining the integrity of the financial system.